Good morning. Call to order the North Carolina Investment Authority Board meeting for November 19th, 2025. Welcome, everybody. It's good to see everyone in the room and welcome everybody online. Let's begin with the Pledge of Allegiance to salute the North Carolina flag. Allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. I salute the flag of North Carolina and pledge to the old North State, love, loyalty, and faith. Thank you, everybody. A handful of administrative items. If anyone wishes to make a public comment, please sign up on the list at the table in the back. Please note that this meeting is being recorded and will be posted online on the board materials. We'll be taking roll call by name for all votes. Unless there is objection, a motion and a second will be counted as yes votes. Finally, texts or other recorded communications between board members during the meeting, even on personal phones, are public records to the extent they concern the meeting. We'll now do a roll call for attendance.
Ms. Lynch?
Present.
Ms. Schuster Russell?
Here.
Mr. Roberts? Here. Mr. Ward?
Here.
Treasurer Breyer?
Present. All right, we have a quorum. Thank you. For ethics, the Ethics Commission made a determination at its meeting last week that the North Carolina Investment Authority Board of Directors is a covered board under the State Ethics Act. We'll be discussing this more later this morning, and more information regarding State Ethics Act requirements will be sent to you by Liz Hawley, the Department of State Treasurer's Compliance Officer. With that said, please take a moment to review the agenda. Does any board member here have an actual or potential conflict of interest in these matters? Okay, very good. We'll move on. Thank you, everyone, for being here again. Today is a big day in North Carolina's financial history. It's my belief and hope that people will look back 20 years from now on the creation of this authority and will see a clear delineation between the before and the after. The promise of delivering on our actually required return may seem obscure to the average citizen and taxpayer, but I assure you, if done correctly, you'll feel the difference. Funding into a pension system to make up for subpar performance will be replaced by discussions on how to balance our budgetary excesses, tax relief, salary increases, cost of living adjustments, and any other issue can be on the table in ways that they simply aren't and haven't been. We're excited for that future, and we've made good progress to building the entity that should take us there. I'd like to thank everybody who's responsible for getting us here today. First, our bill sponsors, House Bill 506, sponsored by Senators Heiss, Lee, and Craven, Representative Jones, Ross, Hall, and Tyson. We wouldn't be here putting this authority into place without their strong stewardship and, frankly, a unanimous General Assembly. Our board members, thank you all for being here. It is public service of this kind that is what makes this state great. I'd add the former Investment Advisory Committee members to that cast, Robert Durden, Michael Kennedy, and Jamie Spencer as well, and of course, the DST team. Kevin, Ben, Jason, Chris, Eric, Amy, Colin, Dr. Hairston, and on and on and on. There is a deep team, and you see many of them here today that have gotten us to this point. And I appreciate all of the work, but we are hardly done. We've come a long way since January. Today is an important step in building this authority, but we have much more to do. Today is big, make no mistake, but tomorrow we must deliver. With this team, with this board, I have no doubt that we will. So thank you for that. Thank you for indulging me. Let's move on to the approval of the board minutes from August 27th, 2025. Those board minutes are in your packet. Do I have any questions or concerns? Otherwise, I'd entertain a motion to approve the minutes from the August 27th, 2025.
So moved.
Thank you. Mr. Roberts, is there a second? Second. Mr. Ward, call the roll, please.
Ms. Lynch?
Yes.
Ms. Schuster Russell?
I'm going to abstain. I wasn't at the meeting.
Can vote on it.
All right, then I'll.
If you'd
yes,
like.
I just don't.
I think it's going to pass anyway, but your choice.
I don't know how to assess it.
That's fine. Treasurer Breyer?
Yes. All right. We're approved. Okay, let's move on to major initiatives and the performance update. And I'll hand it over to Kevin Sigurdsson.
Good morning. So, Matt, have you flipped me over? Yeah. So the major initiatives update is fairly concise because much of what we've been working on for the major initiatives is leading up to the NCIA, which is pretty much the topic for today. Rebalancing, we're pretty much back to standard rebalancing based on the market and our deployment. We've deployed about $6 billion so far this year in excess cash, as well as reinvestment of some disinvestments from some areas I'll talk about a little bit later. And then the asset liability study will be coming in a special meeting in December. This just shows a quick transition timeline, so I can touch on some of the tasks. So this meeting will take up the charter for the board, the policy manual, the first phase of the comp study. Mercer will be here later, as well as our first budget, which will just be for this current fiscal year ended June 30. In December, in addition to the asset liability study for the retirement system, we'll also bring the recommendation on the supplemental retirement plan support. And basically the sequence of events is that board has to make its own independent decision as to whether to continue the status quo, where what we think of today as investment management division is supporting them on the investment front. And the board for the supplemental plan is a December 5 meeting. So we're going to confirm with them that they would like to maintain the status quo. And then we'll come and advise this board on the 17th of December. In February, we'll be bringing the investment policy statement updates and the recommendations there based on the asset liability study, as well as the transition plan. So that's a fairly involved matter. When we've done these transition plans in the past, it might be $5 to $8 billion that we're expecting to redeploy over some period of time. So we want the board's active engagement and endorsement of how we think about approaching the market and what we want to emphasize and de-emphasize. Mercer will bring the phase 2 of the comp study to that meeting as well. And then next May, we'll bring the next budget, which will be for the subsequent fiscal year. We expect to also bring our first strategic plan for the organization. And I feel that's a really important set of discussions we'll have with the board. We'll start those well before the meeting around some key topics where we want to emphasize how we form the organization, how we resource it, some build and buy decisions, not just around investments, what we do internal versus external, but also some of our core functions that are more in the support nature. So like IT, HR, even accounting to that extent, right? So because we're in some sense starting de novo with a lot of our functions, I think it's a good strategic discussion to have with the board. And then we'll also bring a recommendation around administrative fees to be applied for cost recovery on various clients, the mandates that we're overseeing and investing. As I'll talk about later in the budget presentation, we've been on a pass-through model for many years, and we believe admin fees are a better approach. So for day one readiness, we continue to work away on that with various folks in the department CFO, Brandon Watson, Ben Garner, Angeline Hardston, our HR director. And we're moving along pretty well. We still have some documents to do with the custodian to amend that document, the agreement to be a tri-party. And then we have this just foundational stuff, right? So we still need to fill some core investment roles. We need to fill a general counsel's role, HR, accounting, things like that, at least to start that process. We've got to establish some independent functions that historically have really come from the department. Some of this is very pedestrian, but still necessary given our role in the public sector and managing public monies. So for instance, we need to build out a web presence. We need to think about branding. In the web presence, we've created a landing page for this board and the materials, but we have a ways to go in terms of probably reestablishing some of the transparency around what we do, both policies, transactions, our holdings. So we've started to post our holdings. We'll do that on a monthly basis. They're available currently on nctreasurer.com, but as we set up our own pages for the NCIA, we'll start to put our holdings there as well. And so that's about all I've got to say on the kind of the major initiatives. I'll go into performance if that's fine. I'm happy to answer questions otherwise. All right, so I'm going to step through our performance, and again, I'll try to keep it high level, and but would encourage questions and discussion, and then I'm going to throw some of the questions to the team, the directors, and have them address some of their activities directly. So we're up to about 207 billion as of the end of September. We've had really the growth since the middle of the year is really just being driven by the equity markets, both the exposure in the retirement system as well as the supplemental plan, which is heavily allocated towards equities. So that's really been the story of the asset growth. In terms of our house view and how we're thinking about markets, it's a very difficult time to be putting forth a high conviction view on the macro situation. I think Chairman Powell at the Fed has talked about it as a fog because of the lack of economic data coming during the shutdown, as well as a lot of cross currents. So and you'll see this later when we talk about our positioning, we're really not going to pound the table around any kind of high conviction views. We feel there's just so many cross currents in the economy, on the regulatory front, and it's just very difficult to have a strong view towards, is the economy slowing in the U.S.? Is it taking a pause? And what's going to happen in 2026, particularly given the One Big Beautiful Bill changes, the individual tax changes will lead to really large refunds in the early part of the year. We have other things that are happening in the U.S. that are kind of one-off events around World Cup and around the 250th anniversary and things like that, which these are real in terms of how they impact the economy. And on the corporate side, the tax cuts and the kind of accelerated depreciation and things like that are also really positive for the economy. But by the same token, we do see softness in certain areas, and inflation is still a bit elevated. We do expect the Fed to be cutting in December, although we've seen a lot of cross chatter in the press from the different governors and regional presidents. But we think on the margin, like is being priced in the market, there'll probably be a modest cut. We're also staying on top of what's happening in the funding markets. So as the Federal Reserve has been winding down its balance sheet, we're seeing less free reserves and a bit more stress in the short-term markets. So this is the overnight repo markets and SOFR markets and things like that. I mean, to a certain extent, we run all this cash internally, about 50 billion. Our clients benefit by virtue of the fact that those markets are a little bit tight and there's periodic funding needs. But it's still an area, and Brett runs our cash desk and works with Jeff in fixed income. So yeah, go ahead.
Yeah, so we've seen some volatility in the repo market. We've seen rates kind of elevated, largely attributed to a heavy new issuance of T-bills. So as the one big beautiful bill, increase the, basically the budget and the deficit, increasing as well. So we've seen a large new issuance of T-bills, and as primary dealers have absorbed those T-bills, it's kind of sucked cash out of the market and increased the amount of collateral. So it's a supply-demand market. So you have a heavy supply of collateral and less cash chasing that collateral. So as a result, you've seen rates kind of spike up a little bit. So we've settled back in here, kind of in the sub-4, high 3s range from kind of like the 4.25, 4.30 area back in October. So we're seeing some relief there as well. Other complications, with the government shutdown, basically some of the funds weren't released that weren't released or were delayed entering the market as well. So that created an additional constraint on the cash side of it.
So when we think about the markets overall, and you'll see this in our positioning, we've tried to head much closer to neutral in terms of our overweights and underweights where it's feasible. So public equities and on the fixed income side, we have seen, everybody has in the markets kind of the AI narrative losing a bit of steam with some questions raised around the sustainability of the CapEx associated with the data center build out and all of that, as well as individual names just getting massively punished, down 50-60% if they miss earnings or if their earnings call is messy. And so to us, we're not trying to be predicting the short-term movements in the market, but we also don't need to be heroes in terms of being overweight equities. And so you'll see in a bit that we've been rebalancing from equities pretty consistently. On the rate side and IG credit, that's a big part of our book. There we think things are fairly range bound. So Jeff Smith can address that.
We've really been in a range bound environment as a whole and really see the forecast for that going forward. In contrast to we've seen the large movements on the equity side with news, we really haven't seen any volatility on the spread side, especially in investment grade particularly. As a whole, spreads have remained at historically tight level. They've leaped a little bit off that bottom here recently, but really see the forecast moving forward, really range bound on treasuries and the intermediate longer part of the curve. If you take a look at the buying forecast data and Bloomberg, it points to the same thing, a really tight range of distributions. When you take a reading from all the banks and the economists that feed into that number on it, with really things based around plus or minus 25 basis points expectation ranges, really for out to the end of year 26 and 27. Cuts, obviously, the last two meetings, but increasing divide, as Kevin mentioned, on what actions to take. We saw the futures showing 95% of likelihood of that cut in December, and that's led down to like 50% now. I was reading the Fed Speak Index that Bloomberg puts on, recently hit its most hawkish level of recent numbers. So I think it points to a lot of uncertainty around that December meeting going forward. And I think what impacts the longer part of the curve going forward, we're going to refocus on the Fed independence to take center stage again in Q1. Leadership change of the chair, membership levels, points to an increasing bias certainly towards lower Fed fund rates materially if you have what the executive branch wants. I think it's going to be interesting though, is there's the clear sensitivity to inflation at the executive branch as we head towards midterms. So how does that really cross over with the actions that you want on the front end of the curve? We're going to see arguments with Lisa Cook in January. The appointment of the 12 Reserve Bank presidents has to occur before March 1st. So it's going to be an active first quarter on everything related to the Fed. And I think the risk really to the longer end of the curve would really be more if we had a really restructured Fed, implemented aggressive dramatic rate cuts. Maybe we see an economic boom temporarily, but what does that mean longer term on inflation? How does that relate post midterms next election? So I think it's going to be a pretty chaotic period as we get to the first quarter as it relates to everything on the narratives around the Fed and actions of who wins the battles on that front.
There's been an amazing amount of IG issuance from the hyperscalers particularly. It seems to be completely well absorbed.
Totally absorbed. I wouldn't say we're any different now than we have in the last few years. Plenty of appetite. cutbacks in allocation, and nobody is certainly choking even at what are historically tight levels. What we've done in response to that environment, we've actually taken our corporate, we were slightly overweight corporates, we've taken that just slightly underweight. And due to kind of where the thoughts are on rates going forward and range bound, we've been pushing our allocation, our duration relative to our benchmark more towards neutral here as we redeploy money back into fixed income as part of the rebalancing efforts. So it's been a way to kind of in place that. So we're really trending towards more of a neutral stance as we wait for the uncertainty that Kevin offered as a backdrop really to everything.
Kevin, to your comments on uncertainty, I was with one of the Blackstone directors recently who made a comment that they had looked at rolling, and I won't probably explain this perfect, but they had looked at rolling 3-year volatility for every rolling 3-year period for the last 25 years, looking at rates, currency, credit, I'm sure a couple other things that I don't recall, and we're 70% above the average right now, the last 3 years, which just speaks to the environment we're in, right? And how tough it is right now.
You're talking about specifically like move volatility?
Yeah, I think they took the MOVE index, they probably took the VIX, the whatever, the FX, there were 4 or 5 metrics, and I don't have them all written down, but yeah.
So one kind of general question, and I mean, I get where this plays in relative to kind of rebalancing and having views like this, but you know, a large part of the portfolio is really a lot more kind of longer horizon, longer term. Any kind of structural macro kind of trends or items you're kind of watching or thinking about on that side?
If I can, I'll defer that.
We can defer that to
some of
allocation,
our activity.
Yeah.
Because then I think you'll see a flavor of that where we're trying to move the portfolio on the margin, not just in the publics, but on the private side as well. And yeah, so if I can ask for patience, I'll get to work one second.
Okay.
Okay. This is our asset allocation stance as of November the 12th. And the relative overweights and underweights are the second column from the far right. So public equity, as of that moment in time, we were about 60 basis points overweight. And we've probably brought that down a little bit just due to the market action over the last several days. But the intent in positioning there was really to be fairly neutral. The market has just continued to work, and so it's pushed us up, and we've been kind of pushing back against that. And then, as Jeff mentioned, we have allocated to IG fixed income, which has done reasonably well, and so that's given us a modest overweight as well. We have thought and discussed internally whether to take more money off the table in public equities. But our concern is, again, we don't want to lean, too heavily on the view that we have some great insights into the near-term movement of the markets. And as you see, we're 300 basis points light in growth because we're so underweight in private equity, not for real estate, and opportunistic fixed income, which is our non-investment grade fixed income exposures. So we didn't want to take equities down too much further. We did actually bump our cash up a little bit, but it's really in transit. We have such a large amount of money that are going out in the form of new commitments and some co-investments and things like that, that it's really just temporary. This shows our actual rebalancing activity over 2025. So the first half is kind of collapsed into that second column from the left. And then it shows each of the rebalances that we've done since. So you can see, even though we used excess cash to augment investment grade fixed income and public equity in the first half of the year, since those equity markets roared so strongly in the second half so far, we have found ourselves just clawing monies back and redeploying. And mostly we've been pulling money out of domestic equity. So in that last interim rebalance on October the 20th, there we pulled $2 billion out of domestic equities and allocated $1 billion over to fixed income with the expectation, again, that we're kind of range bound there. And then we put $1 billion in cash because, again, we projected that that would be flowing out fairly rapidly. In addition to these moves, we have also done some repositioning within opportunistic fixed income. So we redeemed, I don't know, $500-600 million, I think, Ron? 700, thank you. From broad swath of managers that invest in high yield, leveraged loans, and various credits like that. And it's really on the margin, we see more risk around the credit cycle. We're getting deeper in. Those spreads in high yield space have been really tight. So we've rotated away from that sector to a certain extent. And I'll show you on this somewhat crowded table where some of those monies have gone. So these are the new and incremental investment commitments that we've made since the IAC meeting, Investment Advisory Committee meeting on the 27th, which was also our first board meeting. I'll step through some of the large ones, and I'll turn kind of more detailed questions over to the team. So on Bailey Gifford Private Companies, those are pre-IPO holdings that's a closed-end fund, and we hold it in public equities. That's where the Bailey Gifford relationship is. And we've had good co-investments from them, and we will see co-investments alongside this strategy also. The Kohlberg NC, Kohlberg is a somewhat newer relationship to us in the sense of making a commitment, but the team has known them for a long time. I want to go down to where it reads, there's 3 transactions with Ares. The secondaries fund, a co-investment vehicle alongside, and then this thing called USA, Outside Opportunities. And I guess when I'm from the north, USA sounds normal to me. So what that is that we have several arrangements with Ares where we bring co-investments that we source ourselves, and then we take them to Ares. Ares may take them through their investment committee, but what's useful is they have cloned special purpose vehicles to hold the co-investments. They close them for us as well. And so it's part of a much broader relationship. So what that $500 million does is it really just creates capacity for the team to find co-investments through their various relationships. And then we're able to move in deal time, do our underwriting, which is fairly extensive in terms of cross-checking the kind of the underwriting that the sponsor has, but then also work with Ares, and it allows us to move quite quickly.
So, Kevin?
Yep.
Are most of our directs in special purpose vehicles?
Yeah. Yes.
Are all of them special purpose?
I would say every one of them at this point. And Chris? Yeah.
That's right. Yep.
Yeah.
So we're not really controlling the exit necessarily in it, right?
For all intents and purposes, yeah. Now, there's circumstances where we could be really driving it. So like with Ares, with some of these, we could take them to market, but it would essentially be a secondary, right?
And the other question I have is it Bailey up front up top? You said this is a pre-IPO holdings?
Yes.
And so why are we putting those in public equities?
Yeah, we do it for 2 reasons. One is that's the relationship, kind of ownership has been, we have a large public market mandate with Bailey Gifford that's been in place for a long time.
Okay.
And the expectation is that even though these are pre-IPO, they will probably go to an IPO at some point in time, and Bailey would continue to hold them.
Okay.
And so Bailey has done a credible job over time in terms of the growth space, both public and private. Like a lot of others, they suffered some wounds during the period following 21, 22, but by and large, we have pretty high conviction with that.
Thanks a lot, appreciate it.
Yep.
I have a quick question, and this may be for, it may be more for the December meeting, but how do you currently, and in general, are you thinking about, pardon me, sizing like maximum in a single company or how much to have with a single firm is, where's a maximum limit? How, from that perspective.
We don't have limits, to be clear. And the intent has been to try to concentrate the portfolio. Historically, at least from the time I was here before, we had a steady push to, reflect the growing size of the plan with much larger allocations to managers, and to be comfortable continuing to invest in some of the closed-end vehicles, but also push hard for SMAs alongside for co-investments, special situations, and things like that. And, I'd be interested in the feedback from the board as well, but we're quite comfortable within each of the private market asset classes going much larger. You'll see one on the next page, which you may have already seen, which is a $2 billion commitment to a smaller, newer manager. And I'll explain the basis for that, but we're pretty comfortable given the size of the portfolio at about 140 billion with those types of commitments.
And that's so, and just to raise it, that 2 billion, 140 is fine, right? That doesn't, but I do think there should be as a fiduciary, there should be some limit, whether that's 5% or that's a different discussion, right? And I suspect my view is higher than you'd ever get to. It's just a good, prudent rule limit to be.
Yeah.
But I agree with getting more concentrated.
Certainly, we have the opposite problem right now.
Yeah.
I think our biggest single position is probably NVIDIA. It's probably 1.5%, 2% maybe of the total plan. So certainly we want to put maximum in place, but I hope that we have that conversation in the future about that challenge. We're a long way from it.
Yeah, and I think the nuances are also what's the nature of the exposure, right? What's the governance? So, as we take more control of our plan's future through co-investments and directs and things like that, where we're not as reliant on the counterparty, or we're not locked into a commingled vehicle, I think we need to take that into account as well. I do think, though, it's a great point to make and follow up on when the world's not on fire, right? Because you really want to have that kind of thoughtful, deep discussion early, as opposed to we all lived through the great financial crisis, that very short window when markets were struggling during COVID. But, we want to have a good understanding. The board should have good comfort with so what's our exposure? Just pick a wirehouse, Goldman, right? So we're going to own the stock, we're going to own the bonds, they're going to be a counterparty. Right now, everything we do is DVP, so we don't really take counterparty risk with derivatives, but all of those kind of need to go together. And if it's multifaceted exposure, we need to be able to kind of sort through that and have a view, particularly during crisis when we may need to cut, certain relationships and exit, manage those through.
Kevin, can I just ask one clarifying question before we leave this? Really more for food for thought as we think about reopening the conversation later. Is there a philosophical framework or underpinning with respect to why we want to concentrate more? Is it operational efficiencies? Is it ensuring that our highest conviction managers move the needle? Is it a combination of things? I'm just curious sort of how you think about it.
To me, the thing that's most important is we have so many small positions that they will never move the needle at all. And so concentrating gives us the advantage of going much deeper with our counterparties, right? Knowing them much better. And the return on effort, right, in what can impact our clients is really, it has to be more concentrated. And the kind of the problem a lot of pension funds have faced over the years is the pension funds have grown by multiples, and yet they still think in terms of $100 million commitments, right? That's big, that's meaningful. But for a plan like ours, which is, you know, close to the mega status, given its current size, again, $100 million really doesn't move the needle. So we have one next on the list, which is Maverick Silicon Fund. So that's a new relationship. That's venture capital. It's really dealing with, and then we have a $300 million SMA alongside. So that makes it much more meaningful. And to the extent that that proves out the conviction the team has brought, then that's a relationship we can grow over time, as long as the opportunity is there and it still fits with our portfolio. But we need to have a risk lens that we bring to this as well, right? Which is, that's a large allocation for venture.
On this point, one thing it always concerned me somewhat, because what happens is you get away from the areas of the market where you really do have some very nimble opportunities available, and you can't get to them because they're small. And I'm just, especially in times where there are a lot of changes and disruptions in markets, are we thinking about any way to be able to target and reach those opportunities, as opposed to just sort of saying, well, we're not going to do anything under $100 million?
Mm-hmm.
I mean, always think it's, I mean, you may have already said that to some extent with subgroupings. I just don't, I'm not as familiar with it.
Yeah, I think with, again, it's
not just venture, it's also in smaller managers, but you see it more in venture.
yeah, exactly. Yeah. I think with smaller managers, again, if we act with the strength of our conviction, if we have high conviction with a small manager, we should be willing to become a larger part of their assets. But again, it's going to be situational, right? And being larger with a small manager where it's a blind pool and we have very limited dials to mitigate any risks that arise over time, business or otherwise, that we need to be kind of cautious around. But if we have exits and we have more self-control or governance rights, then I would say we should be more comfortable scaling with a smaller manager. The message that, you know, we've been delivering to the team through the investment committee and otherwise is that it's okay to start small with a manager, but we have to have some reasonable expectation that we're going to be able to scale over size, or pardon me, over time. And so it's not to shut out small managers or new managers at all. We'd love to see new deal flow and differentiated approaches. But we can't ever, again, accomplish our mission and what we need to do for our clients if we're just doing $10 million allocations at a time.
Maybe a couple things I'd add. So if you have a reference that we posted our holdings on our website, and it's .gov, not .com.
Oh.
I think the most recent one was 120 pages, 50 securities per page. So to give you some sense of, you know, the total number of things we own. So we've got the opposite problem that we need to get to. One, two, coming to the public pension plan world for the first time at the beginning of this year, I always thought it was curious that the one embedded competitive advantage of public pension funds wasn't used, and that's the economies of scale. You can drive terms, you can drive behaviors, you can drive outcomes for firms in ways that other industries simply can't. And so we need to lean into our natural competitive advantage in that way. And you'll see it, and you'll hear about some of the things that we've done recently, but I expect that we'll do much more of that, where bringing $1 billion to the party changes the entire thing for the better for everybody. And net of fees, that's even better for us. And I guess the final thing I'd say, and you and I share a fund of funds background at some level, you know, I like to think that there are underlying managers who net of fees add a lot of value. Not a majority of them, not even a lot of them, but enough that it makes sense doing. I think when you zoom out to the fund of funds level, that number becomes very, very small. So yes, you can expand your scope with that type of relationship, but the value capture almost inevitably goes to the fund of funds manager, not to us, which is a problem and a headwind that's really hard to fight. So some more thoughts on the topic, but I think we've made good progress as a team in leaning into those economies of scale. Certainly, there's a maximum amount that you want to be cautious of there. But I think we're
The three that are towards the bottom of the page are another example of the same topic. So this is north of $1 billion of commitments to Benefit Street Partners in a sector that we really like, which is commercial real estate mortgages and related debt. And Benefit Street Partners is a longstanding relationship, very comfortable with them. We see this as we're a natural source of capital where banks are being less active, and there's reasonable spreads. Our expectations are 8 to 10% net returns on these types of investments. Relatively low loan to value, a little bit of leverage on the relationships, and really good terms, really good fees, really great alignment with the manager. And so we like this trade. It's being funded effectively out of redeployment of the monies, to a certain extent out of higher yielding non-investment grade credit. Where again, we're not seeing problems in our portfolio, but it seems like a good time to be pulling down that exposure on the margin and redeploying into this type of a sector. So this, Mark, to your point, this is what we see as a bit of a theme to take advantage of. And these mortgages tend to be 3 to 5 years in kind of duration. And it just is a nice fit with what we think we want to accomplish over the intermediate term. The opportunity may go away for any number of different reasons, in which case cash will come back and then we'll redeploy into a different sector, depending on what's available in the market at that time. On this page, I will just call out again, there's an Ares allocation, a commitment to $500 million. That's a placeholder for us to be able to do co-investments outside of Ares, so we source these through our manager network. And then there's a large $2 billion commitment to Melange, which is a newer manager, smaller. This is a sizable increase in their overall kind of commitments as a firm. And what this is targeting is predominantly traditional energy continuation vehicles. So we see that as an area that's been neglected by a lot of investors because of ESG concerns, non-investment concerns, and the underlying assets are cash flowing quite well. So it's natural gas, it's oil exploration and production. We expect it to be relatively well diversified, and we're able to underwrite each of the investments that might come to Melange, and we have an opt-out right. So we really like this approach where they have technical capabilities, they have domain expertise, they have an excellent network, and then we're able to co-underwrite, and we're able to step away if it just doesn't fit with kind of our risk appetite or our needs in the portfolio at that moment in time. So while it's a small manager with a large increment, we feel the governance and the risk profile is acceptable. And then under multi-strategy, I'll just touch on a couple there. Gladius ARCs, this is an example of us on the margin trying to hedge some of the equity risk that we have in the portfolio. So this is not a tail fund. This is more of a way to take advantage of modest declines in the equity markets. This particular strategy is well known to us. We've invested with the manager for years. I don't know when we first started investing with Gladius, 2011. 2011, yeah. And so this incremental $500 million allocation is not going to change the overall kind of return on our portfolio, but from a relative standpoint, it could be impactful. What we have found is when with this product, this strategy, that when the equity markets are down by more than 1% in a month, that's when this product does relatively well, and then it monetizes quite quickly. So I think, I can't remember the exact statistics, but I think on average, look at those 13 months, the S&P 500 was down about 4% on average over the last decade or so.
Yeah, I guess since inception of ARCS, which was, kind of 2016, 2017, so about 10 years, yeah.
And then this product in those, over that time period, the S&P was down about 4 on average, and then they were up about 2%. So again, it's not earth shattering. It's not a tail hedge that's going to, do phenomenally well when the market is down 15 and 20%. That's not what it's there for, but on the margin, it gives us a little bit of risk mitigation. And then Brevan Howard, this is a global macro relationship with some relative value. We've also done, and left it off here, apology. We also did a co-investment sleeve alongside where we can do co-investments in single trades with them, again, with an eye towards taking advantage of market dislocations. So.
Kevin, just a quick comment. Like, as you described the Melange relationship, I think it's very smart. It'll come back to our conversation later today on comp and making sure we have the team and the resources to execute on this and the strategic plan. But I think it's very smart direction there.
We have high hopes with this relationship, and again, I think it fits well with what we're trying to achieve at the pension fund, right? Which is good returns, very respectable, and it's a kind of a neglected area that hasn't gotten enough capital, and so this is a natural fit for us, we think. Okay, in terms of, and I'll try to speed up and wrap this up in a bit here. The one termination we've had was Franklin Templeton International Small Cap. So we redeemed $800 million from them. It was related to performance, and they had a very challenging 24 and 25 leading up to the point where we made our decision. And there had been some client outflows as well that we were monitoring. And so we've redeployed those monies to fixed income. This is, I won't say much about this, but again, it's just to give you a flavor that we have a very active pipeline. So we have the first block on the top are things that have been approved by the treasurer, going through our investment committee for treasurer approval. So we're in negotiations and final legal diligence with those. There's another large, if you skim your eye down the commitment funding in the middle of 1.3 billion. So that's another relationship of scale in the commercial real estate mortgage space, which again will most likely fund by pulling down some of our high yield and sub-investment grade fixed income as part of this rotation. And then we're building out a relationship with another multi-strategy manager, mid to larger sized, and that would be a fund commitment as well as some opportunistic sleeve where when there are market dislocations, we could opt in, and then a co-investment vehicle alongside. So very similar to a lot of these other structures that we've done in the private space. And then we're working on an infrastructure fund. We've only had a couple of infrastructure relationships, probably about 4 or 5 total when you include some power and things like that. And so this is an area that, again, we think is quite fruitful to be building out at this point. So let me talk about performance a bit. I'm going to focus predominantly on the 1 year. And not so much on the 3 and 5. So it's been a really good year. If you look at our estimate through last week, I think we're up about 11% for the year, and we've had a really nice lift, obviously coming almost entirely from equity markets. Thankfully, we're ahead of the benchmark for this 1-year period as well as for year-to-date numbers as best we can tell. And what's been driving it, this is the attribution. And we have added about 14 basis points of value add. Most of that's coming from allocation and the rest from the selection effect. So on the allocation, non-core real estate's been industry-wide quite weak, and we've been underweight, so that's inured to our benefit. And then cash, that's been a bit of a drag, given that we were overweight and we were deploying, given its low return. If you look at our selection, the weakest area has been public equities, and there was a little bit of a negative attribution to China. So we pulled China out of our passive vehicles. We left it in our active vehicles. And China has had a phenomenal run through most of this year, about a half of the year to date. It's been really quite one of the stronger markets. But we were overweight Europe, and that offset it, more than offset it actually. And we've just had some very difficult selection, stock selection by individual managers, both in the U.S., small cap, mid cap has been tough. And in Europe, some of the stock selection there has been weak as well. So we'll be talking to you all in the new year around how we think about public equities and the structure of that asset class.
This is me probably not being able to read the reports correctly. I was trying to read the reports. What portion of equities are passive and what portion of equities are active? Go ahead, Rhonda.
It's roughly about 50% passive, managed, and the balance of that is spread across active managers.
Maybe the only other thing to note on this page is we did change asset allocation at the beginning of the year. So those who weren't here in January, those targets were different. The portfolio matched the old asset allocation better than it does the new asset allocation. So we've been on a journey to get towards the new asset allocation, principally in cash. From, I think we're at 5 or maybe more, and now we're targeting a lot less than that.
Yeah, it's 5. Yeah. A couple of other notes on the opportunistic fixed income, our distressed book, which is actually relatively small. That's kind of gotten smaller in recent years. That's done quite well, taking advantage of the liability management exercises, the few workout situations. And we've had Jeff's book continue to perform well, a little bit lower duration. So as rates moved up, benefited from that. And then the corporate positioning has been really strong as well by sector. Okay. So I want to stay on pace. So the 3-year numbers in 5, the only thing I'll note again is here we had this large cash allocation. So we were 400 basis points overweight. So that really dominated the kind of the overall returns. And the same thing is true on the 5-year basis. That's really the largest story of kind of the weaker returns. We look at our performance versus peers. We'll be doing more work on peers in the new year, but what we have been using is from our custodian public funds with more than 20 billion in assets. And we continue to lag the kind of the median peer. The good news, but it's really a short time period, is this calendar year to date, 9 months, we've closed the ranks. So we're now at the median on a gross of fees basis versus our peers. So we are at least having some effect there, but it's a very short time period. And I think the last couple of things I'll just note in closing is, so this is the portfolio I referenced to before that Brett works on day to day, 51 billion that we manage internally in investment grade short-term bonds and cash. And so there the portfolio is is doing fine. It's got a current yield of about 4.5, and north of what the custodian would pay and north of the 1 year. And then I'll jump to this risk metrics page, which the one fail I'll call attention to. And again, in 2026, we'll have a risk budget policy that we'll bring to the board, and we'll have a much deeper discussion around what we're trying to achieve and what should be the key risk metrics and tolerances and things like that. But the information ratio for the 1 year period has improved pretty significantly. So it's now 0.24. We hold out, we'd like to be at 0.3 or better, which would be top quartile in the industry. So we're getting closer to that, but we're not there yet. And that number will move around over time, obviously. But
Kevin, maybe a comment on the bond market beta.
Yeah.
Benchmark being so much higher than our target. How should we think about that?
Yeah, so I would say we set that bond market beta expectation many years ago when we looked at through the asset liability lens. I would say that it's an imperfect measure, just to be blunt. I do think one of the useful aspects, and you'll see this in our asset liability presentation with Ortec in December, is over long periods of time, how much exposure we have to interest rate risk is one of the key drivers of success. Because where liabilities and assets can link together is through inflation and then nominal interest rates. So we have to be sensitive to those connections on both sides of the ledger. But I would interpret this with caution.
Thanks.
I think I'm going to stop there in terms of the performance presentation. So happy to answer any other questions, or the team is available as well.
You got what you need, Mark.
Going to go into the next. All right, fine. So the next agenda item is the board charter. And this is really your all's charter. So I'll be presenting the key components of what's baked into the charter. Again, throughout, happy to answer questions and pause for discussion. So big picture, the guiding principles, not in the order of the bullets, but what I would call out as probably one of the more important things that I've seen with boards in the past is on number 3, boards can occasionally drift into minutia. And so one of the guiding principles we've put is that, we think it's important for the board to confirm and agree that they want to maintain focus on the things that are most impactful and that are strategic and policy oriented. Because what we want to be able to have and come out of this meeting with is a clear understanding that the board accepts kind of their role and defines that vis-a-vis management, and then whatever is delegated to management, we're accountable, right? So we need to have that kind of hand in glove relationship with the board where there's good transparency, good trust, but we expect the board to challenge, right? And we want to set high expectations and do our best to meet those. But we really think it's important for the board to stay at that strategic and policy level. And that's how we can drive really good long-term results over time. The idea of having kind of informed, constructive, fair, open, and critical deliberations, that's aspirational. Collaborative and consensus building, again, aspirational, not to suggest that you all won't debate or amongst yourself or have disagreements with management. We will accept that as it comes. But again, the notion of there's kind of a common thing we're all trying to solve for, which is improve our clients' performance over time. These are public monies, and so there shouldn't really be a lot of controversy about what we're trying to achieve over time. And then governance, coming up to this point in time, there's been, as Brad mentioned at the top of the meeting, really, this is a watershed event in terms of improving the governance of the investment programs. So we don't want to lose sight of that. And then the final one is you all are experts in your field. You've done a lot of innovative things in your own kind of practices over time. And so we welcome that at the management level, that we're open to new ideas, innovation, we're happy to trial things. And we think that's a key value proposition for the board. This slide is really more around what the board has to approve as it relates to investment matters. Much of this is already baked into statute, right? It was part of the design of picking up best practices and leading practices among pension funds, endowment and foundations, and family offices. So the comments are there for your benefit. The thing I want to focus on is in statute, it contemplates that there's certain matters that would be reserved to the board for board approvals on investment actions. And so the way we've approached that is to include the investment committee charter and the limits of their authority as the stopping point, and then the board approves beyond those limits. Right? So that's the concept. So peers use two basic approaches. Some do a complete delegation on transactions to the management, then they have regular detailed updates to the board, sometimes in closed session to be able to talk about proprietary and confidential information. Others have quantitative limits per transaction. So it could be that for a private equity commitment, management or the CIO has delegated authority up to 500 million or $1 billion or something like that for an individual commitment. What we're recommending is a blend, principles-based as well as some limits. So one of two slides, and I'm trying to make it a little easier to read by bolding some of the parameters. So on strategic asset allocation, that's really owned by the board. Management needs to be proactive in terms of doing analysis and providing recommendations and support, but ultimately the board approves the strategic asset allocation for the retirement systems and some of our other clients that have strategic asset allocations, and then any changes. So that has to come to the board. And then what we're proposing is that if the markets take us outside of the allowable range for an asset allocation that the board has approved, that if we stay outside by a certain amount for a certain period of time, then we have to come to you all and either get approval or redirection. So this has happened in my career multiple times when there's big dislocations. So during the COVID time period when there were large movements in the markets, during 2022 when both equities and publicly traded bonds fell in value substantially. So then there was a denominator effect. I think the philosophy is those things happen. We don't want them to happen, but they do happen. And we have to approach them as fiduciaries and just make informed decisions, which we would advise the board on, and then the board would make its decision. New investment exposures. So this would be like new and unique things that we haven't done before. So the example I include here are like direct digital asset investments. We haven't done those at the staff level. We've had some exposures within various vehicles, relatively small. But if we wanted to create a new set of exposures that's unique, we would expect that the board would want to have lots of input around looking at a risk assessment plan. Is it suitable for the client? Do we have the infrastructure, the people, the systems, risk measurements, and so on? And we would want to bring that early, have a discussion, and then, get a sign off from the board and be able to move forward. Likewise, if we had any material sub strategy within an asset class, we might want to start small, but if we wanted to build it to be meaningful, then we would want to have that discussion with the board. And then finally, strategic planning initiatives, which again, we'll be talking about some of this in May of next year. It might be like sub-investment grade fixed income. We think we could bring some of that in-house. We need the people, we need systems, we need some resources around research. But I would envision that would be part of our strategic plan. So then we would agree with you all, if you did agree, that there would be a plan around resourcing, testing, some milestones. We'd give periodic updates in these quarterly meetings. And then as there was comfort, we would hopefully, get a sign off that was fine to scale that. So that would be the intent. So let me pause there on this slide and see if there's any questions or discussion.
My only question is under the strategic asset allocation limits, when it goes outside of bounds, do you think 4 weeks is a long enough period of time? Struck me it might be a little short. 6 weeks might be better.
It's conservative, yeah. 4 weeks is conservative.
Think about
Fair. And markets can trend adversely in public markets pretty significantly over 4 weeks and then reverse itself. So I'm purely at the pleasure of the board on this topic if you all want to give more time.
Think about it. I'm just thinking about times when it has happened in my experience.
I think it depends more on how you're going to manage through that time period. So if it's behavioral and you all are going to force yourself to rebalance so you don't have to come and justify the position to us, then I wouldn't do it. I would make it longer. If you're going to truly use it in a transparent way to say, I'd like to have some guidance and some conversation and support around decision making, then shorter is better.
Unfortunately, it's situational, right? Because there can be times that I've had in the past where it's actually a good thing that you're outside the bounds for a particular asset class and it's performing really well.
Sure.
And it's offsetting some of the negative returns of the other asset classes. So that overweight is like, it wasn't intentional, in the moment, but it's doing what it's supposed to do.
The other way I would think about it in that frame would be having that conversation and documenting that's the reason, and then having shared fiduciary oversight of it is better than you all solely taking that responsibility. Again, if you feel like that's helpful.
Yeah. No, I like that approach a lot because I think the cadence of communications shouldn't be too structured, right? So if there is an event in the market that's impacting the portfolio, communicating with the board, in real time, kind of getting a temperature as to whether maybe a board meeting is needed. And it helps we're located in the department with the chair. But having communications with each of you as well, I think that's helpful. Yeah.
One of the benefits and the sage thoughts on the size of this board, it's not a large board. This is not hard to pull together. I guess taking a page from what's happened in distressed credit over the years, these dislocations get more violent and shorter. And if you think that continues to be true, I think you want to convene more quickly. So then we can figure out what we actually want to do and communicate appropriately. So my bias would be shorter, but let's see how it goes.
I just raised, maybe just something to kind of watch. I don't know.
It's a good question. It's a good thing to call out.
Yeah, I think though, to Stephanie made a good point, which is, I think important is that you all are coming to the board for advice, not, hey, we're just going to transact because it's CYA and we don't want to deal with the board, right? That's more the practices, whether it's 4 or 6 weeks, I actually don't know that matters a whole lot. It's more that, hey, we want the board to opine on this and we want to be as thoughtful as possible.
Yeah, exactly. The other limits to the investment committee's authority would be around strategic transition. So I kind of touched on this at the top of the meeting. Well, an asset liability study will come with recommendations on the transition. And some of that needs to be market sensitive, but we also need to have buy-in from the board around what we're going to emphasize, the cash redeployment, basic pacing and things like that. So we would expect to have a flexible plan approved by the board, and then we would go to implement. And we felt we needed to materially step away from that approved plan, and again, we would want to consult with the board. And then the interim rebalancing, again, a lot of our rebalancing I view as more quasi-passive in the sense that we have rebalancing bounds that enforce a discipline of plus or minus 2% relative to the public markets. And so what the 4% would allow us to do is to do a proactive rebalancing from the top of the overweight to the bottom of the underweight, sorry. And so it does give us some flexibility to express a view. But beyond that, we would have to come to the board. And again, my sense of how we would want to operate and how, I think we've operated in the past with me is that we would want to have regular interaction with board members if we're thinking about this large of a move. It's not going to happen in a vacuum. You're not going to hear about it just in the next quarterly board meeting. On the operational matters, again, this is coming to a large extent from statute, some of which will be coming up today. The operating budget, the market compensation plan. I already mentioned the support for the supplemental retirement plans, and I will come to you in the December 17 meeting, talk about that. And then let's see what's new. And then litigation, we thought that was one that we should add. It's not required by statute, but we felt that if management was expecting to enter into material litigation, so we're defining this as $10 million of claims or recoveries, something in excess of 10 million, then we would come to the board, and we would need to get approval if we were to seek any type of appointment of external legal counsel to support that type of litigation. So we feel that that's a pretty standard reserve matter for a board. Okay, so in terms of the charters and the policies, the board would be approving its own charter, the investment committee charter, any investment policy statements that we bring, which would certainly be for the retirement system, and we have several other funds. An ethics and conduct policy, which would apply to the employees of the NCIA. Investment transaction disclosure policy, that is our placement agent policy. And then we'll be bringing a risk budget policy. And then this long list are the policies that we would have delegated from the board to the CIO representing management to approve. So a lot of these are much more in the weeds of our day-to-day. We're happy at any time to bring these policies and walk through them with you all, share them. Many of these will be posted as well, like I mentioned, in terms of our enhanced transparency out to our NCIA landing pages.
Kevin, that's a quick question. Why is the risk budget policy not part of the investment policy statement? Really
It actually has been historically. We had a section, currently have a section, which just sets out the tolerances. But my thinking is that it makes sense to kind of break it out of the IPS, but I'm totally open to having it in each IPS. The way I've approached risk budgets in the past is to emphasize that you want to have more process focused as opposed to like the quantitative numbers. The quantitative numbers are important so everybody understands what we're aiming towards, what's a normal portfolio, and then when do we escalate to the board. Again, I'm open to keeping it, the key components in the investment policy statement, if that's what the board would prefer.
I don't have I'm just used to seeing it as part of the investment policy statement. I don't have if it works this way, it's fine too. I don't have unless others have an opinion, I'm fine. Curiosity.
I think where where I'd like to have more clarity, but again, it could go in the investment policy statement, is at what point do risk levels necessarily have to be escalated to the board? So you all will have transparency, but where the world is kind of evolved is there's a range of risk outcomes that are kind of in the expected range, and then there's an amber level, and then there's a red level. And as we go through amber and get to red, which will happen eventually as markets don't cooperate, the red level is where the board really needs to reinforce what management is doing or recommending or redirect. So that's where I see the process being important to define from a governance standpoint. Management's responsible for, owning those risks and managing, but at a certain level, the board needs to get involved too. That's the idea. These are the board delegations to the CIO. So as the principal executive officer for the NCIA, the idea is that day-to-day management around administrative things, personnel, budgeting, legal, operational, risk management, compliance, technology, all that is really the responsibility of management. Creating positions, employing staff, that's within kind of the statutory delegations that are contemplated. And then the ability to negotiate, renegotiate, and execute contracts. That doesn't need to involve the board unless the board wants to be involved. But what are set aside as reserved matters are if we wanted to appoint a new custodian bank before we could execute a contract, and we expect those to be tri-party with the department as well, that would come to the board to approve that appointment. Same for external auditors and then the legal services firms to the extent there's litigation. And then these are the board oversight responsibilities. Again, these are very straightforward, what you would expect to see. And then on the board code of ethics, there has now been an official an opinion or ruling? Determination from the State Ethics Commission that this is a covered board and subject to the State Ethics Act. So Appendix 2 of the charter kind of captures that with a bit more color. And maybe Ben, if you wanted to comment on this, and then we have Elizabeth Hall here as well, and helps us the ethics liaison. You kind of can talk about next steps. But
Sure, yeah, some of you may have had experience being on subject to the State Ethics Act before. There's a number of things that Ethics Act requires, filing of a statement of economic interest, regular ethics training offered by the commission. And then, because the State Ethics Act now applies to the board, Chapter 138A, there's requirements about acceptance or non-acceptance of gifts and things like that. So as questions arise, individual questions, please interact with us and we will interact with the Ethics Commission. And Ethics Commission is very helpful. They'll provide advisory opinions, things like that. So yeah, as specific questions, factual scenarios arise, let us know and we'll work with you and work with the Ethics Commission to make sure that we're all staying clear of the ditches. Anything else? And Liz Hawley, our compliance officer with the department, she'll be sending some information to you all very soon related to Ethics Act requirements. There's some things like the statement of economic interest, probably not going to want to file till after the first of the year because there'll be a new form available. And so you would want to refile multiple times. So, but Liz will send more information to you.
okay. So that concludes my remarks on the board charter. So
Thank you. So we do need to vote on accepting the board charter. So is there any further discussion before we entertain a motion to that effect?
No, I'll just comment. I think Kevin and the entire team, you guys have done a very good job being very thoughtful about this. I agree. The best boards aren't involved in the weeds. They're involved in critical, high-level discussions. And I like the way you laid out the key risk limits. Some of this will be in the U.S. policy statement and the risk policy, obviously, but I think you've done a good job at striking the right balance here for how really the best boards do function.
I might just add, I think the clear delineation of roles and responsibilities is such an important factor here. I think you all have been as well. Certainly a best practice and, leads to the best outcomes for the client.
Echo those comments. Quick question. Let's say that we get a year into this and we feel like there's a need for a modification or a change. What is the procedure to do that?
Well, there's plenty of insertion points, right? But we should be reviewing the charter on an annual basis. And then, do this from memory, so I'll get it wrong. There's baked into the charter as well a self-assessment by the board, right? So a lot of boards do those annually, and it ends up being a lot of overkill if there isn't like turnover on the board. So we may have put in that it's at least every 2 years biannually. But that's a really, really good practice, in my experience, to be able to use a third-party facilitator to pull information and feedback from each of the board members around what could be improved, both in the boardroom as well as vis-a-vis management, and then use that as input into updating. Yeah.
Simple majority, super majority?
Simple majority.
Simple, yeah.
And
I think it will not be surprised that everyone here knows that we're doing this for the first time. And we're doing things for the first time. We do make mistakes.
Sure.
And that's okay. It's not okay if you don't learn from them.
Well, and that's why I was asking, what is the procedure to modify?
Right. And so I think that's very much in the realm of expectation.
Yes.
We will need to modify something as we learn to live with this, and learn how it functions over the course of the first year and thereafter. So, we expect that by the end of next year, we're amending this in some way.
Sure.
I don't know what it is. That's why we're not doing it today.
I'll just add, it doesn't have to wait for an annual. Sure. If there's something that the board believes needs to be changed, bring it up. We'll do a red line, and then the board can approve it. So yeah, there's a cadence like Kevin talked about, cadence thought about, but it also can happen at any point with the board that you can change the charter.
I wasn't thinking it was going to be complicated. I just didn't want to assume.
Sure. It's fair.
And I think it's good to have these documents, right? It kind of sets out hopefully a common understanding. But we should view them as like living documents as well, right? And in practice, if there needs to be course adjustments, yeah, we want to be serving the board, right, in whatever you need. So, another part of what's in the board charter that I didn't cover, but I'll mention it now. We state that, we would expect the board to have complete access to senior management of NCIA, right? And we want to actually encourage that, again, because you're experts in your field, and having access to the directors, the leaders of the various teams, and having discussion, that's great. We would appreciate that. I think, there's some protocol around, if you're hearing from investment managers that we're not being responsive, or they don't really understand how come they never get a phone call returned or an email, then send those my way, right? And I navigate those. If there's complaints about Sigrist, which happens sometimes too, those go to the chair, right? And I think that's a good protocol too, that we try to be responsive. There's thousands upon thousands of managers, as you know. So we can't be as responsive as maybe each of them would like in the aggregate, but we do want to have open doors and take meetings and have information flow, even if it just doesn't fit with our portfolio. But we need to have that. We think that environment where both we're interfacing with the market, but also you all are interfacing with our senior management.
Yes, so if we come across a manager or an opportunity that we think is a good one and the bunch to think about, who do we go to for that? Do we tell you? Do we tell the individual director?
I think it's totally fine to pass those contact information and thumbnail to a director. And our process is predominantly bottom up. And I don't see that changing. So most of the sourcing is coming from the teams, not just the directors as like a rainmaker, but we try to push it down to the portfolio managers and others as well. And so I serve as traffic cop sometimes. And then I use the word predominantly because, it's important. Again, the board has to set out certain, things like the strategic asset allocation, the risk appetite, stuff like that. And then I work on policies as well, which set up guardrails and establish good, strong checks and balances. But I feel like having that bottom up, so you all interacting directly with the asset classes, that to me is optimal.
And it might be useful to discuss, this is not a normal condition in the pension world. From the endowment foundation perspective, family office perspective, it's very normal for boards to interact with staff routinely to help source things. But in the pension world, that is not the custom. So we're going to act differently, way better as a result of that. But it is different than most everyone else out there. And so you all should be aware of that.
Can I go ahead? So 2 quick notes related to that. One is because the State Ethics Act will need to be very thoughtful about conflicts of interest. So we will be providing additional guidance related to that. So something we'll need to be very careful about. And the second, just a quick point, as there's communications, because this is a public body, we'll also need to be careful about complying with open meetings laws. So if there's communications via email with the whole board, okay, well that starts to cause a problem with open meetings laws. So I just flag those. Nothing to stress about at this moment, but just be thoughtful that we'll be providing guidance, but those are things to be also have in the back of your mind. It's a public body and the State Ethics Act applies. That's it.
Well, all right, I apologize if I'm if we get exposed to an opportunity that we think is good, but it may not be that big and therefore might not be a good, do we have an obligation to make you aware of that fund that's coming out and these managers that are splitting out? Is there any kind of obligation of?
No.
Okay.
You do not have a legal obligation to do that. No.
Just trying to grow your list of managers. 'Cause
Sure. Yeah. Oh, but if it's a scale, there's capacity, and you think it would be a great fit, we would love to hear about it. Yeah, absolutely.
Yeah. And again, our job is, multifaceted in the sense that we look at lots of managers that maybe aren't a great fit, but it's a research opportunity as well, and build relationships and understand what others are doing maybe at smaller scale. So we take lots and lots of meetings where not necessarily going to lead to a transaction. So again, we're happy to take those on board and see if there's places for that.
Unless there are any other questions, we do need a motion to adopt the charter.
So moved.
Is there a second? Sure. All right. Mark, Mr. Roberts, second. Call the roll, please.
All right, Ms. Lynch? And Mr. Ward? Yep. And Treasurer Bryan?
Yes. All right. Thank you. So we're running quite a bit ahead of schedule. So why don't we give everybody a 5-minute break, reconvene here at 10:35. CIA meeting, and we'll move on to the policy manual. So back over to Kevin and Ben.
Great. So on the policy manual, this is really picking up from the board charter where it's essentially all the other policies that the board needs to approve. So a little bit of this is a review. One will be the investment committee charter. So a couple changes relative to what we've had at the department, voting requirements, and then those limits on authority that we just reviewed. The investment policy statements, first one will come in February, and then that's for the North Carolina retirement systems. And then we plan to do asset liability studies for some of the smaller plans that we have also, and then build out to the extent they don't already exist investment policy statements for those during 2026. So that'll be part of next year's agendas. And then the Venture Capital Multiplier Fund. So this is something that is done, allocated within the sheet fund. It's a small commitment. We don't expect to renew this. The performance has not been up to expectations. And it also, the investment policy statement, because of how it was originally developed in conjunction with the governor's office, and there was input from a committee appointed in part also by the General Assembly, that we'll keep that at the management level. We don't expect to be doing any updates on that. Then on the ethics and conduct policy, that's what applies to the employees of the NCIA, not the board. We've done a pretty substantial rewrite of those policies because we had multiple levels of ethics policies in the department. So I'll cover that in more detail in a minute. The placement agent policy, or what we're now calling the investment transaction disclosure policy, very limited updates, mostly to clarify the treatment of direct investments. And where that comes up is for direct investments, it's quite typical that investment banks are used to raise funds, or there's real estate brokers, right? And they get paid as part of the normal course of business, as part of the deal. And so we needed to carve those out. Those are not really placement agent fees in the kind of classic sense, where there's a series of regulations that apply to placement agents following the abuses that occurred in the public pension fund space, notably a number of years ago. And then the risk budget policy, we'll have further discussions around whether that's in the IPS or it's a standalone policy. So in terms of the investment committee charter changes, the first notable one is, again, with the treasurer historically having the statutory obligation and authority to be the sole decision maker on investments. The investment committee was really consensus driven, and it was there to provide advice and counsel. So we'll take formal votes moving forward in the investment committee for new investments, secondary transactions that we might want to sell some pieces of the portfolio, termination of managers, that kind of stuff. So that's in the charter that was provided to you all. And then likewise, we would take votes as we currently do on rebalancing and stuff like that. We give ourselves in the investment committee the ability to make decisions via a circular resolution, which is handy from a management standpoint. So in essence, we don't all have to be in a live meeting and record it in the way that you all do under public meetings law. And we can have substantive discussions and then document it in a memo that we circulate and get approval. So it's still a vote, but we wanted to make that operational efficiency available. The other thing I'll call out is continuity. So with the new governance structure, we want to have this investment committee be able to be durable regardless of whether there's a sitting CIO. So similar to the way that you all are set up, that if a board seat goes vacant for a period of time, the board can self-replenish and propose a new board member. So we can't ever have a vacant board, right? That would be far too risky. And in a similar fashion, if the CIO seat is vacant, then the Chief Risk and Operating Officer, Chris Morris, currently would sit as the chair. He's essentially the kind of staff director or the vice chair of that committee anyways. And then if both positions are empty, then the committee can appoint a chair. So again, it's just for continuity purposes in the hopefully low probability case that the CIO seat sits vacant for a period. On the ethics, and the conduct policy update. So as I noted, we had multiple policies because we have different types of employees within the department that are subject to different types of rules. So those have all been consolidated into a single policy. We're creating a compliance risk and ethics committee to provide oversight. So the department has such a committee, but it's a little bit different in the sense that the department consists of 6, 7 divisions. So it's a bit more complicated in terms of management and so on. So we'll have a single committee that will have a bit more power. The NCI's general counsel will serve as our chief ethics officer, and that committee will weigh in on a number of different things throughout the year, including conflicts and regulatory compliance, enterprise risk management, which is another initiative that we'll build that out consistent with our size and complexity. And then the gift rule. I want to focus on the gift rule. So historically, the department has adopted I guess it's the former Governor Perdue's kind of executive order. Is that the way to phrase it? Do you want to talk about that, Ben?
Yeah, so the department years ago adopted Governor Perdue's executive order. Although as a council state agency, it doesn't necessarily have to, but it did years ago. And that's just maintain compliance with that. The NCIA doesn't have to follow that executive order. And the way we phrase it is it's using it as it's informative, but it's not required to comply with it. And so working with Kevin, we tried to build in a bit more flexibility while still being very careful about principles.
So we looked at other public pension funds and how they approach gifts. And in essence, what we're trying to solve for is, consistent with my earlier comments, we need people out in the field. We need them interacting with potential sources of investments. And in the normal course of business, we're doing business meetings and we have coffee, notepads, all these very incidental things, which under the strict application of the Governor Perdue's executive order are prohibited. And so we've found that just like other public pension funds, it's much better to just recognize that there are going to be these kind of exchanges, that they don't rise to the level of having to record every bottle of water and every coffee. But there are ways that we can create good transparency around where there might be, gifts. So I'll cover those in a second. First, there are many circumstances under which we cannot take a gift, right? And so if the gift is intended to influence our behavior and look favorably upon a manager or an investment idea, then we're blocked, right? That's just not allowed. So we're not losing, any of that rigor. We need to be making unconflicted analysis, deliberations, recommendations. All that might lead to a closing and an allocation of monies from the funds. But what we've done is we've carved out certain exceptions, and that's what's on this slide. So we follow practice of other public pension funds where we say there's certain things known as nominal gifts that are just incidental. Here we say that's a market value of less than $25, right? Those are acknowledged. Gifts between employees and board members, that's okay too. Maybe there'll be a gift during the holiday season or something. But just to make it clear in the policy that that's allowed. And then relating to food, lodging, transportation, and entertainment, food and beverage, which would be consumed at a single meeting, typically a business dinner, where the vendor or a proposed vendor is present, that's allowable, but not to exceed $150, which we think is reasonable for some of the higher cost markets that the team traveled to. If it's in excess of $150 for a single seated meal, single meal, that's permissible if it's at a conference or a banquet. And, the vendors are there. It's basically being furnished to all the participants. And so again, that will simplify life. And it's just the reality that there's a lot of annual general meetings that our team goes to. We want them there, not only to surveil and diligence managers, but also to network. That network across the investor community outside of just public pension funds and endowments and foundations is really a rich source of information. So we want to encourage that type of interaction. We try to be on as many limited partner advisory committees as possible, or their kind of substitute governing committees in these partnerships and joint ventures and things. And we routinely, like other investors, negotiate that if we go to those as a member of an LPAC, go to a meeting as a member of an LPAC, that the fund picks up the expense, that doesn't fall on our assets directly. And so to the extent that an employee can get reimbursed lodging, transportation, or entertainment, then they request that. Their supervisor, which would be a team lead, would have to sign for that, and then the CIO would have to sign for it as well. Again, as long as it meets a NCIA purpose and there's a representative there from the kind of the investment manager and so on. And then there will be documentation of all this. Our general counsel, once they're seated, will determine all the requirements. And then this compliance, risk, and ethics committee will review that at least annually to look at how the team is traveling, where we're getting reimbursement, the gifts and things like that. So there's plenty of transparency, plenty of oversight, and it's going to come from the control function, not from the travelers. Right? So there's clear segregation. So let me pause on that. I have one more slide, I think, on the gift rule that I'll talk to, but
Kevin, forgive me, you might have already defined it. The members of the CRE committee.
Yeah.
How is it comprised?
Yeah, so that would be the general counsel. We have this notion of a compliance counsel, which is a member of the legal team that looks at conflicts of interests during the course of a transaction. So they would be on the committee, and then Chief Risk and Operating Officer would be on the committee as well. And it's set up so it's a co-chair. So the general counsel is the chair, and the Chief Risk and Operating Officer is also a co-chair. And what we've done historically is regulatory compliance has been with the legal function, and investment compliance, like guidelines, has been with the Chief Risk and Operating Officer. So we think joining those two up creates the right balance.
Thank you.
CIO is not on that committee.
All right, a couple just quick questions on this. Probably one's for you, Ben. Do you feel like business conferences covers like LPAC and AGM? Like, I know it's getting technical, but I just want to make sure you're comfortable that it's worded properly. I imagine you are, given.
Well, yes, on the front end, yes, but I'll just say what we talked about with the charter. I expect this will be iterative, and we're going to refine and narrow or expand as we need to. But yeah, at the front end, we're pretty comfortable with how we've got it, but we are very open to making sure we get it right. And like I said, I expect it'll be iterative.
Yeah, because I think we're all aligned on the spirit. And then two other questions. One is, Kevin, what happens if granted, I wouldn't expect you or to be going to many LPACs, but is this covered if you're going to the LPAC or your position? Because I didn't read it that way here.
Yeah, no, it would apply to me as an employee. If I'm the CIO, then I'm an employee of the NCIA, and it would cover me.
And then do these policies get reviewed every year? Or
That would be the idea, yeah.
Yeah, because like those limits are fine now, but in the future you want to increase them, obviously.
And like the $25 even, I think one of the plans that we used as a model, they're at 50. We went a little bit more conservative. the 150, I think others have some higher limits as well. And it's not to say that we can't, on a case-by-case basis, sign for a waiver or an exception, right? If somebody's going to a particularly high-cost market, Tokyo is an example. But again, the exception should be few and far between. And we want to set this up so that it's constraining, but it's flexible. On the two other things on the gift policy, one is that we don't want to lose sight of common sense. So to the extent that the policy might allow the receipt of a gift, but it just doesn't look right and smell right, then we need to exercise judgment, right? So I don't have a great example of what that might be. The one that comes to mind would be if we were in a litigation stance or a particularly contentious business dispute. I would find it really weird to sign for someone to take what might be conceived or perceived as a gift from the counterparty. And so, again, sometimes, we're living in a fishbowl. We want to, do and act right. Sometimes we just have to say, notwithstanding that it's allowed, it's not what we want to kind of demonstrate in terms of our values and things like that. So.
If something is within the allowed levels, is it a public record what that amount was?
If we're collecting the information, yes, right?
Yeah.
And,
Oh, yeah.
Do you mean more though if they go to a conference?
Yeah, I'm thinking
And
you
then
go to
we're-
a conference.
That's what I think she's
Kind of
meaning.
more what I was thinking.
Do they actually disclose at a pension conference that when they broke down the 200 members that were there, it costs less than $150 per person? Is that information out and available for people to
yeah,
monitor?
so again, this is something that still needs to be decided, to be frank. There's a fair number of public pension fund peers that routinely ask of, say, the general partner, what's the estimated cost per participant? I think most folks would view those as really rough estimates at best. And I'm not sure they're really that reliable, but a more simpler question, does this exceed $150? That I think is actually more accurate to get. And so then again, we can take that under consideration as to whether we're comfortable with that when we're signing for it.
And we have the ability to rely on their answer.
Yeah.
It's documented. Okay.
That's right.
Rule of thumb with respect to public records is it's all a public record unless there's a specific exception. So it's all public record. And that's a good rule of thumb to keep in mind.
Okay. And then the final thing is if, and this is a pretty standard part of these types of policies, that if an employee, gets a gift that is prohibited, then it can be refused, returned, you pay it down. Then again, the compliance officer is really going to be in the middle of this as well. So there's a series of things that are unchanged. So our approach to use of state property, limitations on lobbying. We have requirements around regular ethics training, the SEIs that you will file as covered board members. We will have a very similar, and I expect to have an expanded statement of economic interest that's done in-house. Those, because they involve some financial information, those may be non-public records for the employees. And then limitations on future employment in terms of cooling off periods, avoiding the revolving door, side switching, things like that. We'll initially piggyback on the department's hotline, and we may develop our own over time. And enforcement and the ability to provide waivers is also already in our policies, so we'll have that. So that's it for my presentation on the policy manual.
Better the board, paint the picture on compliance architecture, where we are and where we're headed.
Yeah. I think on where we are is I think we have pretty strong processes around compliance applied to investment guidelines. And on the public market side, that's done quite well through our custodian. That's pretty straightforward. We have some pre-trade compliance as well for internal trading, so that the guidelines, we avoid violating the guidelines. So like credit quality, things like that. It's really not possible to push a trade through that doesn't meet the requirements. I think where there can be more effort exerted over time, and is probably around the privates, and in a couple of dimensions. One is guidelines. So virtually every partnership has some geographic guidelines or types of allowable investments, and we can surveil that, if you will, or kind of oversee that through the teams, through capital calls and the details there that come to us, but we're not as tight in terms of the review of that by a control function, really with the front office, the relationship owner. I think that can be improved over time. I think on the regulatory compliance side, that's another area where we have a good legal team, both internal and then external relationships, that definitely help on the front end when we're doing legal diligence and negotiating. We have a pretty extensive review of conflicts that come through our external legal counsel. That's something I always touch as well for every deal. But in terms of the ongoing, especially as we do more directs, both in the private space and as we do more things internal on the public side or the quasi-public, that's where we need to really build out more resources and more advice around regulatory compliance. I think that's definitely on the forward calendar for building that out. And then the other is around some of the things related to personal trading by the team. So we have a pretty standard approach, but we can take it to a better level, where we can have a platform where pre-trade compliance would be requested. Pre-trade clearance would be requested, and then that would be much smoother and more automated. We could also have a much better administration of a blacklist of where we're active in a name internally, and we just can't allow individuals to trade those names. So that's actually a policy that the personal trading, insider trading, use of MNPI, material non-public information, all of that. That's another policy that's well along in terms of development. And we've started to identify, we have one good candidate firm already that others use on can administer this. So that's another build out for sure. Yeah. Is there anything else that I missed?
I think as a very generic matter, state ethics law does a great job in a lot of things, but it's not bespoke for financial services or investments. And so there's some areas that we want to add on to enhance it, to make, again, NCIA the best of class organization that we don't want it to be. And so you'll see a lot from the team over time.
Along those lines, is there any specific policy on soft dollars?
Not actually. The soft dollar has not been that big of a deal, or even bond credits like it used to. There's to the extent that we start to lean more heavily on street research, and soft dollars might come up in that context. But on the bond credit side,
It's seen in our world quite a while.
yeah. What about on the equity side? It could be, again, as we build out our internal trading. So one thing we would like to entertain in the equity side is special situations portfolio. That'd be more fundamentally driven, or it might be a mix of quantitative and fundamental. We have good quantitative expertise in-house. Then again, kind of a richer type of relationship with the broker-dealer community could lead to some soft dollars.
I know that in investment houses, one reason that you have to get your trades, et cetera, approved is so that you can't front run the organization. It strikes me that since we generally are outsourcing, others are more or less on the public side, doing that, do we expect to have that kind of regimen or restriction?
It will be part, yeah, of kind of building out the personal trading requirements. So there's an absolute ban on front running, right, to be clear.
Sure.
Absolute ban on use of insider information or material non-public information. And we create, like the investment committee oftentimes will hold a executive session and things are held behind a conflict wall because the team is in receipt of, or potentially in receipt of material non-public information. And so we want to make sure that we keep that kind of hauled off. But again, the absolute ban is understood, but we just need more visibility of people's actual trades.
Because, and on say, for example, IPOs, when, because you're going to know when they're coming out or they're going to be done. But I think that the question of can someone participate in an IPO, what level, say, 5 minutes after it hits the public market is okay, but being is important. But I also think it's really important to not be too restrictive in it, because I think some people just automatically cut off so much, and it's just that's something I would be aware of.
Yeah. Thank you.
It's very hard to get any of it.
Okay, so we need to approve the policy manual. Unless there is any other discussion on the topic, I'll entertain a motion to approve the NCIA policy manual effective January 1st, 2026.
I'll move it.
Ms. Lynch, is there a second? Second. Mr. Ward, call the roll, please.
Sure. Ms. Shuping-Russell. Mr. Roberts. And Treasurer Reiner.
Okay, now we got a question. When will Mercer be here?
We thought at 11, but
He'll be here at 11:15.
Okay. So what would your recommendation be do?
I don't want to just guess. Is the lunch here?
It's 11:06.
Yeah, lunch was planned for 11:30. Yeah, and so our fallback was if we went faster than the agenda sketched out, that we would just have Mercer give their presentation, and then lunch could float. So if y'all want to take a break until Mercer gets here,
Take a brief break and then dive into Mercer once they're here. Okay. So we will plan for, let's call it 10 minutes and re-engage at 11:15 for thereabouts. Thank you.
Okay.
Good. All right. All right. Call back to order the NCIA board meeting. We are joined by Josh Wilson from Mercer. Thank you for being here. Looking forward to going through the market-oriented compensation presentation. Turn over to you, Josh.
Fantastic. Well, thank you for having me. My name is Josh Wilson. I'm a partner with Mercer Consulting based out of Atlanta. I've been doing this work for about 30 years. About 25 of it I've been doing state pension plans. So I've worked with a number of different states. I had the opportunity to work with North Carolina about 10 years ago. I'll go into that in a little bit, but thank you for having me. We were engaged to take a look at the compensation levels of the positions that will be moving over to NCIA in the new year and understand how they sit compared to the marketplace. So that's what we're going to present to you today. And there's really three things that we want to talk about today. If I could go to the next page, please. First one is the compensation philosophy, right? So what are your guideposts? What's your North Star? What are you trying to benchmark against? Very important to make sure we understand that as we look at what your level of competition is, who are you getting talent from, who might you lose it to, those kinds of questions. Once we establish that, then we look at market competitiveness to understand where you currently sit and what it takes to get you to where we believe is competitive. With that comes a salary structure to allow you to maintain that over time, right? This is not a exercise in getting you there and letting you fall back as you've actually done over the last couple of years. I think what you want to do is make sure you have a way to maintain the competitiveness moving forward to allow you to attract the people that you want, importantly, and to keep the people that you have. I think those are two very important parts of this process. And then the third part, or the fourth part on the numbers here, is looking at an incentive plan. Many of the sort of large and leading pension plans have an incentive plan. And it's no surprise to anybody here. You're at a level that it's more often than not that there is an incentive plan based on performance, based on outperformance against benchmarks or whatever you decide to pick. And that's probably what you need to ensure that you're going to be competitive and pay people based on performance, not just on showing up. So I think that's an important aspect to it. And we'll discuss, what elements go into the design of that. We're not trying to design it today, but just talk to you about what elements you're going to have to think about as we design a plan, if that's the direction that North Carolina wants to go. Any questions so far? Terrific. Well, then if I could go to page 4. Perfect. So compensation philosophy, apologize, a lot of words on the slide. Essentially, your philosophy is you want to make sure you can attract and retain and motivate the right people to help the state of North Carolina, right? You have $200 billion in assets. It's a lot of money. You want to make sure you have the right people managing it. The more you can manage internally, the less you're going to pay in fees, those types of things. So, but you can't do that with the wrong people. That's a recipe for disaster. So you want to make sure you have the right people. So we look at the competitive landscape on the bottom left there. What we're looking at really is other asset management organizations, both in the Southeast and across North America. And I say North America because the Canadian model is something we probably want to look at over time. We haven't looked at it yet, but we want to look at it over time as they have changed their model in terms of who they compete with and how they get talent. And that's been fairly successful. So we will look to Canada for that as well. Looking at both pension plans and also endowments and foundations. And you say, well, we're not exactly like an endowment and foundation, right? A big endowment is $30 billion. But the talent level, the talent that you might look at is very similar. You have some very big ones and successful ones here in the Triangle area. And there's a lot more of those than there are state pension plans. So we see a lot of movement between state pension plans and endowments and foundations. So we at least want to take that into consideration when we look at salary levels. Now, they're very different. Endowments and foundations pay a lot more than public pension funds. So we're not going to be able to match those, just like we're not looking to match what Wall Street might pay. But understanding what they pay and incorporating some of that to make sure we're competitive, I think is where we want to end up. When we have all that, we want to pay the median of the market for salaries. So that means the midpoint between the 25th and 75th percentile, and that's based on salaries. So then the question is, well, how are we going to get great talent if we want to just pay at the midpoint? Well, the answer is going to be an incentive plan. So when we look at a total cash compensation situation, salary plus a bonus, we'll design a bonus plan that allows you to be in the third quartile of total pay if you perform. So your salary would be at midpoint, and if you do well, your total compensation would be in the third quartile of the marketplace. If you don't do well, then your compensation is either, it's targeted at the median of the market. So if you just meet your goals, you'd be at the median. If you don't meet those goals, then your total compensation would be still at the salary at the median, but you wouldn't get a bonus. So that's really the pay for performance model that makes a lot of sense in a public environment. Private environment too. I want to say that differently.
Can I just clarify one thing? Because in a system interpret, when you say third quartile, what you really mean is the 25th to 50th percentile, right?
Sorry. So
I think of that in a second. I just want to make sure.
This is actually something I need to remind myself of, because in the investment world is actually the opposite, right? So I'm thinking about, so at the bottom is 0, the second to bottom is 25th, the middle is 50th, 75th is the second to highest, and the 100th to be the highest. So I'm thinking in the upper
50th, I guess. Yes. Yeah.
Thank you, though.
That's what I thought you meant, but I wanted to make sure. Yeah.
Okay, terrific. Going to market competitiveness then. So we did a study. We looked at the positions within NCDST and said, okay, these jobs are going to be moving over to NCIA. How should they be compensated? As I mentioned, in 2016, I was the consultant that helped NCDST with the compensation study then. And at that point, we made a philosophical discussion or philosophical agreement to target called the midpoint of the third quartile, so the 63rd percentile, which is halfway between the 50th and 75th, of base salaries because we weren't going to put an incentive plan in. So we thought that positioning would be reasonable to attract people. We knew we weren't going to have an incentive plan, so we needed to be competitive. So we benchmarked all the jobs at that level and made some big moves at that time. So at that point in 2016, everybody was pretty much at or just below the 63rd percentile of the marketplace. And there was a plan in place to keep people there based on a variety of factors. But the market keeps moving, right? So the market doesn't stay still. The market's been moving at, basically 4 to 6% per year on average. Some years a little bit more, some years a little bit less. And unfortunately, North Carolina has not kept pace with that. So the jobs at this point have fallen below the market. And that's not surprising if you haven't made big moves because the market keeps moving. So when we did this study, we found that on average, the jobs are it's at the 25th percentile. So significantly below that 63rd percentile, but even below the 50th percentile, which might be okay still. So that was our finding. It's not terribly surprising, I don't think, because not a lot has been done on the salaries in the last decade. And the market continues to be hot for these types of roles. Not every role, but the types of roles we're talking about here really have never gone out of fashion. They continue to be important and even so. So what that's going to require us to do is update/change your salary structure. So you have a structure today. What we'll show you is, when we have a new structure, we have a couple ways we can do it. We can totally demolish the old one and create a new one, or we can take what you have and adapt it to the future. And that's what we've done. And we'll show you that in a minute or so. So just a quick price on the methodology, and I won't go through this page, but we looked at the investment jobs at 75% pension funds, 25% endowments. So that was the weighing of our surveys. We can change that. You could say we want 50-50 or we want 100-0. Easy to do. It's just math. The non-investment jobs, sometimes I'll call them investment adjacent, things like the investment accountants, jobs like that. We looked at those as 50% general industry, because that might be where you get them from, and 50% pensions and or endowments and foundations. There's not as big a difference on those types of jobs between pensions and foundations as there are on actual investment jobs. Does that make sense? Okay, and then we looked at,
Is there a delta between general industry and pension and endowment fund that's material?
Not really, not for those types of jobs. The reason we use the general industry is because not every organization, think about endowment foundations, they don't necessarily have as many jobs as a pension plan does, right? And then the pension plan surveys may not cover those positions all the time, the same ones you have. So we have to supplement it with general industry, but we don't see a big gap between those two.
Thank you.
When we looked at public pensions, we looked at pensions that were above 100 billion in assets. So tried to get them as comparable as we could to you. And then when we looked at endowments and foundations, we looked between 10 and 30 billion. We could have picked smaller, we could have picked bigger. Pretty much any endowment and foundation cut we picked was going to pay more than state pension plans do. We picked 10 to 30 because that was the range of some big ones in the Raleigh area that we thought were reasonable bookends to a sample size. Okay, so if I can take you then to the salary structure. So just in general, the payroll there's 36 current incumbents in that are going to move over to the new structure. The payroll for those 36 is about $7.2 million. Just keep that in the back end. We'll come back to that number in a minute. What you're looking at here is the current structure. There's 14 grades from ID 25 down to ID 12. The chief investment officer is in the top grade, investment accountant is in the bottom grade. And you can see the midpoint, the minimum, and the maximum there. Because we're comp geeks, we put in things like midpoint progression and range spread. It's not of terrible concern to you, but just shows you the reason you have a range spread. I'm sorry.
What those mean? I'm sorry. I'm not.
Sure. The midpoint progression is the difference, if you look at the top line, between 350 and 400,000 in the middle. That's a 14% spread. So the difference between midpoint to midpoint, grade to grade. So, right. And then the range spread means if you hire someone who doesn't have a lot of experience, you might not bring them in at the midpoint. You might bring them in the lower end of the range. And someone, who might be in a destination job, has been there for a long time, there's nowhere else to go, they might be above the midpoint. So we have a spread of about 50% from minimum to maximum to allow for employee progression and development. That's fairly typical. You'll see in the new structures that we change that a little bit to allow for a little more flexibility at the more senior levels, a little less flexibility at the junior levels. Overall, that's 50. We could live with 50% without a problem. And the range progression from the midpoint standpoint is relatively consistent. It's not perfect, but it's relatively consistent. We don't see any 35% and then 5%, right? And that's a problem because when you see those kinds of things, it's hard for employees to understand if, and I think this is very visible to them, how come I'm not in that job or how come I'm not in this job? The ranges don't make sense. So it's nice to have it in an orderly fashion. So the next page is with the proposed ranges, proposed salary grades. And so what we have here, we've left the top couple open. We've proposed 19 grades here. And you can see, just to compare a couple of them, in the old structure, the most senior jobs, the chief risk and operating officer and fixed income roles were in ID 23. We've moved them to ID 25. The midpoint of that salary range before was 310,000, and now it's 478,000. So you can see it's been a pretty big movement to get them to be competitive. Obviously, at the higher levels, you're going to see more movement than you're going to see anywhere else. We have a little more order here in the midpoint progressions and the range spreads. They're 50% for the middle of the structure. They're a little bit lower at the lower end, a little bit higher at the higher end. That just gives you more flexibility to hire who you want to hire, allow developmental opportunities at the upper ends, and still manage compensation. So if we put in place this structure, and if I can take you to the next page, I think they're purple, might be red, I'm not sure. Diamonds on this structure represent your people that we would put into grades and where they compare to that grade itself. So you can see, for example, on the lowest grade there, I think it's 12, there's one job in there and it's just at the bottom of the range, but in grade 13, that job is actually below the bottom of the range. So what this indicates, ideally all these purple diamonds would be right around the middle of the range. That's where we want to get you to. But right now, when we look at current compensation, most of them are below. And that's, again, not surprising. You haven't really kept up with the market. The leaves have been falling off the trees and you haven't raked them. So not surprisingly, you have a lot of leaves in the yard. So last time we really raked them was about 10 years ago. This is not surprising at all. To move everybody to competitive, right? Because that's obviously an important question is, okay, if we want to do this, what are our costs to make that happen? That's $7.2 million in payroll where you currently are. To get everybody competitive with just those 36 people moves to about $9.8 million. So about $2.7 million increase to get.
Could you just talk a little slower, please?
Yes, I can. I'm from Atlanta, but not really from Atlanta, so I apologize.
You're very familiar with all these numbers because you've been talking about them now.
Sure. So current payroll, $7.2 million. The new payroll, if we had everybody at the median of the range, the salary midpoint, would add basically another $2.5 million to the total cost. And and then the other part of this is what we're really looking at here is you have 36 incumbents today. You want to have 60 in the future. That's the staffing plan for the future. That total compensation will be closer to $14 million once you hire all those people. They're not below market because you don't have them yet. Once you have them, your total payroll will be, if they get slotted into this structure at around the midpoint, would be around $14 million. And just to give you some perspective on that, a basis point here is about $20 million. So you're talking about 2/3 of a basis point for the staff to manage. And we'll come back to that number in a minute as well.
So Ryan, I did need to ask one clarifying question. So I was totally with you with 7.2 to 9.8, and you're just bringing the current team up. And I was with you until you did 36 to 61. So the $2.5 million that you added in quote new positions, are those just only ones that have been identified that we're putting in here? And you're not, these are, you want to scale ultimately to 61, but we just haven't defined specifically what some of those are, so we're not pricing them?
So for the budget purposes, we were thinking that we would bake in over the next 18 months to go to about 61 positions.
Right, I saw that.
Yeah. So for purposes of what Josh and Mercer have done, they've taken these hypothetical positions, which they're not all been created yet, right? And priced them. And then some of that flows into our budget presentation later today. But if you go back a couple of slides, I'm not sure this is the right one, to show where you've got the asterisks on the new positions, one more.
Yeah.
There. Yeah, so this is for the purposes of trying to have a once and done on the comp study, at least as it relates to the base pay. We've put in positions that have yet to be created or filled. So general counsel is an example, ID 2022. We have investment directors. Those are the asset class team leads typically, as well as a few others. And then the general counsel in italics, I guess that's italics, that has to get created. And so we priced it, so you all can see that. Investment accountant is another one, investment accounting supervisor, and then the ones that are below as well. HR director, business analyst, those don't exist.
Got it. So I assume when I look at the next page, Josh, because I do actually have a little bit of experience with this, so you're creating new levels in order to re-rate people appropriately based on the future-looking structure.
Yes.
Right? Because I'm with you on that too. Again, the only place you lost me was when you went 9.8 plus 2.5 doesn't get me to 14.
No, actually, it was 7.2 plus the 2.5 or 6,
Yeah.
depending on the people, get you to about 9.8.
Okay.
The 14 million is where you will be in 18 months
With
once you hire all those people.
I'm with you now. Thank you.
I didn't want to call them increases because they're sort of new headcount, right? So it's
Yeah.
not, we're not asking you to increase the current people to 14 million. We're asking you to increase the current people to about 9.8. And then when you hire the new people, your total payroll cost at that point would be 14 million.
Perfect.
Now, depending on how long it takes you, right? Because there's also going to be increases, hopefully on an annual basis to keep up with the market. So, the market keeps moving, right? It's like water in a river.
If I could add one more contextual comment. The way we prepared the budget is to get the authority to create the positions as we need them, but to have a governing max on total personnel cost.
Yeah.
Right? So you all don't have to, if you want, that's different, but you don't have to be involved in creating individual positions. So we come to you like in the middle of the year and go, we want to hire a couple more accountants, or you change your mind and we don't want that position, we recreate it or whatever. That it seems like consistent with the focus of the board on strategic policy matters, you should be comfortable with proposing a limit or approving a limit on total personnel cost.
Great.
And then we figure out like, when do we hire people and what type of people, what positions.
Sure. I mean, again, depending on the skill set of the person you hire first, that may or may not affect, how you think about potential hires after that and so forth.
Yes.
So I'm great on board with that.
In some things, we want to retain this option for build versus buy.
Yeah, sure.
Fantastic. Appreciate the questions. If we go to page 13, this just gives a quick summary of where those increases would come. And the point of this chart is to show you that most of the increases, so the top line of the current total payroll increase that you see, that 2.4 million, we break that down into different components based on what the jobs are. On the right, the table shows you where the jobs are. We'll look at this as investment jobs, investment adjacent jobs, and then other supporting roles. And the point of this slide is to show you that the vast majority of the cost increase is coming on the investment jobs, right? It's not the support jobs. It's not really the investment adjacent roles, although they go up a little bit. It's really on the investment jobs, which is the key to managing that $200 billion. Right, so we want to make sure those people are competitive, and we would argue they're not especially competitive right now. That make sense? Okay, terrific. So before we move on, so what we've covered so far is a comp philosophy and then where you are against market. Before we go on to incentive plans, are there any questions about this? Anything?
I just one question. So everything makes sense. When I look at, and everything's in line with peers and comps here, when I look at the ranges, our ranges are much wider than peers. And I'm just curious what was behind that, the thinking behind that. Just proposed.
So you're talking about from minimum to midpoint to maximum?
Like we're 50 and 40%, and most of the comp data is like 25 to 30.
So the comp data that you're looking at is the 25th percentile to this 50th. There's a little bit of a difference between that and a compensation range. So what we're doing is we're allowing for people to be hired at lower than the 25th percentile of the marketplace and allow them to be paid more than the 75th% of the marketplace within your structure. That's just a philosophical question. Most organizations that I work with they're better about using the lower end of ranges than they are at the higher end of ranges, right? It's very rare to find someone who's almost at the maximum of their range because there's a massive tendency to want to promote that person and get them out of there. So we want to allow you to, because we know some of these jobs are destination jobs that people will be in for, years, if not decades. We want to make sure they have compensation room to grow so they don't have to look elsewhere for another job. I think that's where we end up losing a lot of people they tap out at the maximum in their organization and the money is just too great somewhere else and they go somewhere else. So that's why they're a little bit wider, particularly at the top of the end.
Yeah, thank you. That makes sense.
Okay. Well, then we can switch gears a little bit and talk about incentive plan design. And so again, we're not designing the plan itself, but I just want to talk to you about the inputs and what we're seeing in the marketplace. And this is a very hot topic right now. It's been
So with what we're going to till now, it's totally been base salary and not incentive, right?
correct. Just base salaries. And if we didn't have an incentive plan, let's talk about that for a second. With no incentive plan, you're still competitive on base, but you're competing, with one hand tied behind your back, right? Because almost universally every endowment and foundation has a bonus plan, and the vast majority of the large and complex pension plans have an incentive plan. And some of the larger and more complex pension plans are putting in long-term incentives, so an extra layer. So we're not looking at that right now. What we're looking at simply is an incentive plan that would help keep you competitive, but not just give it to you in base salary, right? Require outperformance for the state in order to earn that bonus.
Yeah, if I could just make an observation there. I think it's important for the level of understanding of the audience to say it's not just because we want to pay these people more money. It's because we actually want their outcomes aligned with the results that we expect for the client. So this is a really important tool.
Yes. Right, because you want to make sure they're competitive. Otherwise, you won't get the talent and won't keep the talent. But if you just give it to them base salary, then the outcomes are unimportant to them, but they're very important to the stakeholders in North Carolina. So you want to align those two things.
If I could offer a view on that as well. And just had a discussion with the staff at 8 o'clock this morning, right, on this very topic, that this, I feel, is like our largest strategic risk, that we're not competitive to be able to recruit and retain, and in a way that gives success, high probability success for our clients. That's what's really essential. And having churn and just say, oh, we'll just go get another person to replace the one that left, or the 10% that left, or the 30% that left, it's just not credible to be able to create the kind of return outcomes over the long term. So to me, it's really has very little to do with the current team. It's all about the roles and dealing with strategic risk. That just has to be front and center.
You haven't gotten to this yet, but are you including some kind of vesting feature in the incentive comp?
That is a discussion point. That's actually for, I think, you to decide, but that is certainly an alternative to think about. And I just want to add one point on compensation. I'm a big believer that you can't really win with compensation, but you can lose if you don't have it. And I say that to say the people that work here aren't working for the money. They can get more money somewhere else. What they love is the culture and the mission, right? But you want to make sure the compensation is adequate to them so that the mission and the development and the culture that's being created here kicks in. If you're vastly underpaid every day on the way to work, you're wondering if the mission and the culture makes sense. So I think that's really the ultimate goal of these types of situations, is to make sure the compensation is adequate enough to get people to really buy in and be able to accept the mission and the culture. So on that page, I think it's 15. Can't see, too small. Yep, 15. Just talking about the other plans that are out there. So as I mentioned, most of your neighbors, Georgia, Florida, Virginia, Tennessee, Texas, California, North Dakota, which is not a neighbor, Wisconsin, Colorado, Wyoming, Ohio, all the Canadian pension plans, all the endowments and foundations, they all have an incentive plan, right? If you took it outside of government and state work, most asset management positions have an incentive plan, partly because you can measure it. We get this question a lot, like, well, how can we have incentive plans in state government, right? We don't do this for any other part of state government. Why for the investment group? And the answer is because you can measure performance far more accurately than you can in almost any other part of state government. It's hard to say if other departments have really done, better than expected, as expected, worse than expected. You can really tell pretty easily with investments, right? You have a benchmark, you're comparing two numbers. So it's very easy to do. And that's why incentive plans have been pretty popular in state pension plans, when in the rest of state government, you rarely see incentive plans. So when we put these in, the chart on the right there with the yellow sun in the middle, it shows you all the things that go into the design. So first of all, eligibility, right? So who is going to be part of this plan? Then what levels of target award should we have? The green circle there, probably the most important, what metrics what are we comparing to? And we'll talk about these more specifically in a minute. How are we going to weight them? Leverage, so was there an upside? Is there a downside? Is there a cap to the plan? Payout timing and scheduling. So is there going to be a deferral feature? Are we going to use some hook to retain people over time? Then the administration, questions that we'll get to that seem pretty basic, but have tripped up and confused a lot of different states. So if I go to the next page, and we'll dive in just briefly on some of the questions that we're going to have to answer around that. And those were the circles you saw. So eligibility, right? So should it just be the direct investment folks? Should it be everybody within NCIA? Should it be direct investment plus specialized investment knowledge or investment adjacent? And there's arguments on both sides of this. If you decide to include everybody, the argument is, look, we want everybody in the organization to benefit equally, to be on the same team and not create haves and have-nots that are working side by side in the trenches. The argument against it would be, does an investment accountant have different knowledge than an accountant somewhere else in the state government who doesn't have an incentive plan? So those are the things that we're going to have to decide on what makes most sense for NCIA. When we look at target levels, meaning what size should the incentive plan be, there's a very wide range. Some of the large leading funds have 100% targets for chief investment officers. Some other ones have 45% targets. So there's a big range out there. And we have all the data on that. We took a shot at sort of figuring how much the target value might be of this plan if we put everybody in it at what we thought were sort of reasonable-ish levels. We came up with a number of just below $6 million for an incentive plan. And that would mean that you are meeting your benchmarks or you're beating it by the accepted amount that we agree on. Again, and that's about a third of a basis point, right? So I was trying to do the zeros on that. That's 0.003%, right? So, and we're talking about billions of dollars about performance. Typically there's, other plans I've seen, in order to get target, you need something like 20 or 30 basis points of outperformance. So 20 or 30 basis points times 20 million is a lot of money compared to the $6 million we would pay for that. So, the return to the state is like 99.999 something percent. So it's not a question of cost sharing, right? It's a question of making sure it's competitive and getting there. We talk about the weights and the metrics. Typically these plans have a combination of total fund performance and then some measure for asset management or for asset class performance, and then usually an individual component as well, right? So for some people, there might be only two. For example, the CIO would just have total fund and individual, but an asset class manager might have 50% on total fund, 30% on their asset class, and 20% on individual. And those percentages will certainly vary by level. What we're measuring is going to be interesting. So do we measure against the benchmark? Do we measure against the actual rate of return that's expected? Do we do both? Do we do a peer group of other funds? So those are the questions, again, that we want to make sure we answer. And there are some practical realities to that. And then, the next question is, over what time period are we going to do this? So if you're measuring investments, the longer the better, right? So 10 years would be fantastic because that would take into account any, recessions or spikes or whatever we happen to look at. But from an employee life cycle standpoint, it's going to be hard to wait 10 years for a bonus payout. It's not practical. 1 year on the flip side is too short to measure an investment return. So what we typically see is 3 years, which coincidentally is what the number typically is in the private sector for equity, whether it's restricted stock or stock options. 3 years is about the combination of length and an employee life cycle. And you may have a dual look at this. You might say we want 5 years and 3 years, or 3 years and 1 year, or 5 years and 1 year. You could have any sort of combination of that. And again, there's always pros and cons to it. Let me just sort of give you an example of one. If you measure 3 years and 1 year, which is a fairly common combination in states, and you have 2 years of great performance, and the third year, you might not beat benchmark in that third year, but over the 3 year period, you beat benchmark, and you're going to pay out an incentive. Well, if you're just looking at the 1 year as a, you know, a stakeholder in the state, you'd say, well, the state just paid out a bunch of bonuses and look how badly they did this year. If you dug into it, you'd say, well, look, yeah, but we're looking at over a 3-year period. So there's a recency effect, which is good and bad. So those are things just to consider as we design these plans is, you know, what makes sense for the employees, what makes sense from a public relations standpoint and communication standpoint, and what's best to make sure that we're motivated to beat the benchmark every time. When we look at leverage and caps, typically these plans have a target level and a maximum level. Maximum level tends to be either 1.5 times target or 2 times target. So practically, if someone has a 50% incentive target, in that 3-year period, they absolutely destroy the benchmarks. You know, probably billions of extra dollars of value are created. You know, they might get 2 times, they might get 100% of their salary for that, as opposed to their target of 50%. Again, the returns to the state are, you know, 99.9999%. It's not even a question. Plan timing and payout, to your question, Sally. If someone earns $100,000 of a bonus, you have a couple of choices. You could pay it out immediately or as soon as it's practical. You could pay out some portion of it immediately and keep part of it for a year or 2 or 3. If you decide to go that route, then you have some other choices. Let's say there's $50,000 that's being held. Do you just get $50,000 in a year, or does it get sort of co-invested with the fund? You know, that's what you see in the private equity model, right? So you invest it with the fund, so goes the fund, so goes your payout. There's good and bad to that too, right? If the fund goes down, then the $50,000 goes to less than $50,000. If it goes up, it goes to more. So there's certainly skin in the game and shared accountability in those types of models. They're a little more administrative work to implement and maintain, but there's a lot of wisdom to them. Sally, did that answer the question?
But it puts the question out there.
Okay. The longest I've seen is a 2-year deferral on that. And there are some complications to it, which is why not everybody does it. Some people have done it and pulled it back. Some have not done it and then added it. But I think, you know, we don't see 4 or 5-year tails on these types of things. We typically see either a 1 or a 2-year tail. But since the plans are overlapping, every year that you would create more tails. So in terms of people not wanting to leave, assuming that you're having good performance, there's always going to be reasons, there's always going to be money on the table that they don't want to leave behind. And then the last discussion is on the next page, which are some of the administrative issues. And these are sort of interesting ones. The plan period, well, it seems basic, right? If we were in a private organization, we would measure from January 1st to December 31st, because that's the most common investment period that people think about. But in state government, you know, you have sort of the opposite calendar, right? You have the July 1st to June 30th. You know, should that be the plan period and the starting date? But again, pros and cons to that as well. How do you treat new hires? So if someone joins 2 years into a plan, do you give them credit for the prior 2 years, or do you punish them if the prior 2 years weren't good, or do you just give them the period of time they were there for? Right. So again, administrative questions that we just have to answer and be consistent with as we go through on these plans. What happens if someone leaves the organization? If they retire, that's one thing. You know, death, disability, another. If they quit to go somewhere else, that's a different answer. So just making sure we have all those situations thought of and accounted for. And I promise you, some will come up that we haven't thought about. You know, what if someone transfers to a different part of the state? Right? How do we handle those kinds of questions? And then the last one, which is so far unsolved in my 25 years of doing this, is, you know, what happens if you outperform the market, but the markets are down overall? Do you pay a bonus or not? You know, investment professionals would tell you, look, that might be the time when they add the most value, right? If the market's down 16%, you're only down 12, that's incredible performance. But pretty easy to write an article that says, hey, the state lost umpteen $1 billion and we paid out $6 million in bonuses, right? So that's the question that you want to understand and think about how you might address it. Other states have said, well, we'll accrue that bonus, but we won't pay it until we have a positive return. That's worked in some cases. The flip side of that is then 2 years later when you pay it, you're paying that one with another bonus that you already accrued. And the number seems pretty big, even though it's actually over 3 years. So every one of these situations has a pros and a cons to it. I think it just comes down to deciding what we think is best for the state and for the investment professionals, and then going with that. I said a lot in a very short period of time. Apologize for the speed, Sally. Any questions on sort of the design elements? Again, we're not designing it here. Just want to give you a flavor of what goes into the design of one of these plans. And obviously, I'm pretty passionate about this. I think these plans are great. I love them because they don't pay out unless organizations perform. And I've really seen organizations change the behaviors when they have these types of plans. Or they really focus in. I've seen organizations look at outside managers they had been using that have been underperforming for years and say, well, look, now that we're getting paid a bonus on this, those managers are gone and we're going to either do it inside or get better ones. So it really does change the behavior, allows people to attract from not just in other endowments and foundations and pension plans, but private sector as well. The Raleigh area is a big draw for a lot of people for personal reasons, right? They went to school here, they're from here. It's a great place to live. You just want to make sure the compensation is competitive for those people.
So do you anticipate that you would make these decisions based on the fund as a whole performance, on the asset class performance of which that person is managing?
I'm sorry, could you say that one time?
So would you look at these incentive comps based on the fund as a whole performance, or would you look at it based on the asset class that this manager's?
So let's say you had an asset manager in equities, for example, and they had, I think I used 50, 30, 20 before. So 50% of the total fund. So that's part of their bonus. If the total fund outperforms, they get that portion. And we also measure their asset class. And if they outperformed on that, they get their 30%. And then there's also the 20%. But there's situations where the asset class outperforms, but the total fund doesn't. Again, we'll have to make a decision if we pay them for that or not. Other situations where the total fund outperforms, but my asset class doesn't. Do I get to share the whole pie on that one or not? And then questions about, can my individual performance be great if my asset class performance wasn't, right? So there's a tendency in all management to rate their people well. But if you have a hard metric that says I didn't do well, but you say, well, but aside from performance, you did great, Josh, right? So that's a tendency we want to look at and understand if we're willing to pay for that. Or do we want to zero that out? So I think the answer to the question is we would measure each of those components separately and decide how we want to add them up.
And if someone's new or they're adding new legacy, if you had a legacy portfolio that was underperforming, but the portfolio that you brought into it, so to speak, was good, would you somehow account for that in the compensation?
If you improved a portfolio that you brought in?
Yeah, if I go in and start managing the portfolio that's here exists, but since I've come in, I've been able to say, oh, these are great managers over here. We should go with these guys. And so a year or two from now, it's really gotten a lot better. But those because the managers I brought in here versus what the ones that were there. And I'm wondering if we differentiate that at all, or is it just too much to go?
I think that would get covered in both the individual portion, right? So that your individual objectives, but also the asset class performance, and then uphill to the total fund performance. So I do think it gets captured. Whether it gets captured immediately is always a good question, right? So I make the change today, but practically that change doesn't kick in for maybe 9 months or whatever the number is, and I'll see the impact for another 12 to 15 months. So it's not immediate, unfortunately. But the behavioral side of it, I think, would be. You'd recognize that quickly.
So process point, and then I'll offer my unrequested view.
What do you think, Kevin?
Thank you. So coming out of this board meeting, Josh and his Mercer team will be interacting with you individually to gather feedback, because the decision around the design of the incentive plan is really anticipated to be put to bed in February. Right? So there's a lot of weighty decisions to kind of process and so on. My view on the asset class level as being part of the calculus is I find that it can introduce some perverse incentives around people battling to get capital to somehow improve their performance, which may not necessarily be the best use of that capital. So, I've worked almost entirely with systems that had total plan focus, weighted across clients, the ones where we had the most discretion, and then individual performance driving as well. But with individual performance, you have to have a much more rigorous calibration approach, where people across the organization are being rated, evaluated fairly and equally across the organization. So it creates a lot of requirements around soft processes also that traditionally haven't really existed. Because our individual ratings are just don't meet and exceed. So it's very, very condensed. But again, I'm not trying to influence. That's my particular experience with these plans.
So then maybe,
Quick trend question. What do you see on the benchmarking at the total plan level? You see kind of a policy benchmark, or you tend to see an actuarial?
Usually policy. So based on the asset allocation model. And that's changing, right? Because I think one of the things I just read it a day or two ago in P&I, CalPERS is all in on their total portfolio approach. Right. So, what's going to have to follow there for them is how do you then measure the performance? What was the benchmark, right? I think they said it was going to be 75% equity, 25% fixed income was their benchmark. But typically we do see, sometimes we see both, to be fair. I've seen situations where you have both. And what happens generally is if the market is down, neither is going to, you might pay out one. If it's up, you're almost always going to pay out the actuarial one, because that tends to be lower than typical market returns. So I think whatever's important, I think that's part of the decision questions that we want to talk about is what's important to the stakeholders, to the board. Do we want to have more than one measure? And that we certainly can. Texas, for example, Texas Teachers has 4, right, which is complicated, but they can manage it well and they've covered all their different bases. So I think it's just a question of how you want to design it.
So to that end, and it's kind of a related question to the observation you made, we've talked a lot about the quantitative side of this today. And a leading institution, Josh, that you work with locally that I'm familiar with has introduced a qualitative component to the way in which they're thinking about that, which is somewhat of a watershed event for them. And I think my question would be, are you seeing more of an introduction of a qualitative component?
Ideally, these would all be balanced scorecards in some way, right? With one of the quadrants, if you will, being financial performance. The hard part in the state environment and this public environment is you have to defend against, why are the payouts what they are if it's not just based on financial? How come everybody else doesn't have a plan like that? So what's happened is most of the weighting has gotten put on financial, even if there is sort of balance, but it's an unbalanced scorecard in many situations, right? Where it's the vast majority on financial returns and some nod to, behavioral and strategic and sustainability kinds of measures.
Well, to that, and that's why I'm interested in your observations and perspective, Kevin, because in light of the strategic decision that you would like the board to consider about moving away from pass-through and, relying more heavily on some of these metrics and surface level agreements and, in a sense, creating a scorecard of profitability, if you will. Yeah. Do you see a qualitative component of some percentage being aligned with that goal? Is that something that is important to you, or how should we think about that?
Yeah, I really like the balanced scorecard approach. And I think it might be distant because we haven't had issues, but we could have a risk blow up. We could have hopefully this never happened if I'm here, a non-responsive approach to an audit recommendation, right? Just a control weakness. So if those aren't addressed, why would we be giving a full performance incentive payment, right? That makes no sense. So you have to drive the right behavior. And it's not just let's get really high returns. It has to be in the right context. So I think in a balanced scorecard, you can pick up the financials, you can pick up some of the control measurements as well. And then I like the individual level, which would require us to build that out more in terms of ratings and so on. But it's a way to encourage kind of behaviors that will impact future performance, as opposed to just looking in the rearview mirror of our returns versus actuarial or benchmark or whatever, right? So again, as a an operating manager, executive, whatever, the notion that the front office, the legal team, the operations team, the control functions, they need to work together. There needs to be transparency, and we're going to get much better outcomes. And if the incentive plan doesn't build in those incentives, right, towards good behavior, then we're kind of missing the boat again.
I kind of agree with you more, and I think to a certain extent you named, as by example, because I'm sure they were the first ones that came to mind, more punitive types of behaviors. But to the extent that the this body is focused on bringing more of the investment management in-house. So we're moving away from a truly oversight model and more of an active investment model. Then those positive behaviors are the ones we want to incent and align with outcomes. And we need to be able to do that qualitatively as well as quantitatively. You're just asking more of people. You want them to think differently, and to do that, you need to align the plan in such a way that it compensates them when they do that.
I agree, and I think there's a word that gets thrown around a lot is aspirational collaboration, right? And people go through the motions, but until they're actually all tied together economically, the collaboration is not really the same. So again, we'll talk a lot more about the investment process and structuring of the portfolio in the context of the asset liability study. But this notion of a competition for capital, maybe not a complete total portfolio approach, like some of our brethren are doing, but we need to have that competition for capital. But alongside that has to be collaboration where people are willing to share ideas and feedback and stuff like that. So again, it all has to like come together organizationally, in my view.
I'm curious on the other pension plans particularly, how many of them are using peers as part of their evaluation matrix and how many are something else?
Most do not use peers because the practical reality of that is it's hard to get the measurements. You know, the asset allocation model, it really is the primary differentiator between the returns, right? But for the trustees who sometimes are, state employees or teachers, there's an education factor and an understanding that's easier to explain. How do we do against Oregon or Washington or, so that's the rationale for the peers is we're better than these states. If you ask me, I don't think that's the best way to do it, but there's certainly an argument for doing it.
So then I know we're building on how we're going to do the next iteration of this conversation and analysis. I think in your exhibits on the peer side of things, Josh, it would be really interesting to see what the performance rank of those pension funds are next to the names.
Sure.
To try to give some visibility to this is what we're trying to benchmark ourselves against. These are the people, A, that we would want to hire possibly, or these are certainly the people that we would, given where our rank is today, aspire to be.
The nice thing about this space is you can see it every day, right?
Yeah. And then on the E&F side of things, I know you said earlier, because there are obviously a couple of folks in the geographic area that are easy for us to comp to, but there were a number of other ones on there that I was just curious kind of what the thought process was, why.
We took everything between 10 and 30 billion.
That you have access to.
That we have access to, right? So the entire database.
Thank you.
We benchmarked, we sort of bookmarked it with, I think, Duke and UNC, right? And used those as the two extremes and then took everybody in the middle. So to recap, we've established a compensation philosophy, right? That I think do we need approval on that? Is that how?
Well,
I think at some point you want to move to a closed session to discuss the CIO employment. So we would do any votes after that.
Right, so just a process matter. What you see doesn't contemplate discussion about CIO compensation because that's an individual compensation matter. We will discuss that in closed session. After we're done with that, we will come back, we will take votes on the compensation piece of this, not the incentive piece.
The salary.
Salary.
Yeah.
And then we'll ratify whatever decisions we make in closed session, open session as well. So that's the order of things. I think we need everyone to be sure that they're comfortable with the salary piece of this. So that's, I think we'll make sure we do right now before we adjourn into closed session. So are there any other questions for Josh and discussion items on that? Let's make sure we surface them now.
But then, Josh, you're going to, after this meeting, reach out to each of us individually on the incentive and.
Correct.
Yeah, that's why I haven't really, that's what I thought, so I haven't offered up.
Right. So all the things we just talked about in theory, we're going to talk to each one of you individually, summarize that, bring it back, and then come to a group decision on how we would like the incentive plan to work.
Are we going to look first at the, bringing on these new positions, even though we haven't filled them or put the salaries on them yet, and then go into the salary and incentive components?
So we'll discuss the budget as the item after all this, which will include all of those.
Include all that.
so I need a motion. I need a motion. for that closed
So do you need a motion to go to closed session? And I think just procedurally, the process, we also talked about doing lunch at the same time. So we'll go, and so we won't actually have a lunch break. We'll just eat lunch during the closed session. So,
Correct.
yeah.
So we have to do that. in open session. So, yeah, logistically, we will go upstairs. We will convene closed session up there. We'll eat lunch there. My guess is we'll be back at 1:15. Just for those who are not informed. Officer, I need a motion to go into closed session. Mr. Russell, your second. Second Ward, I'll call the roll. Aye. Okay, we'll move into closed session back in an hour. All right, you ready? The board has returned to the Dogwood Conference Room after being in closed session and will now vote to return to open session. Do I have a motion and a second to return to open session?
So moved.
Mr. Russell?
Second.
Second, Mr. Roberts. Call roll, please.
Ms. Lynch?
Aye.
Mr. Ward?
Aye. Thank you. Okay, so coming out of closed session, the first motion that we will entertain is the board will first move to offer appointment to Kevin Sagers to be the Chief Investment Officer for the NCIA for a term of 5 years in salary grade NCIA 28, beginning on January 1st, 2026. Additional terms connected to the CIO's appointment will be finalized following the approval of the market-oriented compensation plan, which may be reviewed by the board at its December meeting. Do I have a motion and a second for this action? So moved. Mr. Ward, is there a second? Mr. Russell, please call the roll.
Ms. Lynch?
Aye.
Mr. Roberts?
Aye.
Treasurer Bryant?
Aye. Okay, the next motion that I would like someone to make is to approve the market-oriented compensation plan from Mercer.
Second.
Mr. Roberts, call the roll.
Ms. Shipping Russell?
Yeah, aye.
Mr. Ward?
Aye.
Treasurer Bryant?
Aye. Okay, let's move on to the budget discussion.
Great. So on the budget, switch me over, Matt. Okay, so to set the context, we're going to show a couple of longer-term trends of where we've been at in terms of the budget, particularly around the North Carolina retirement systems, and then some of the other programs as well. And we think it's important to kind of set this context as it relates to the longer-term trends. Otherwise, if you bring an eye to the budget, it looks like we're going to have a big increase, and without the right context, that's not going to make sense. We don't have a strategic plan, so a more typical budgeting process would be connecting spending requests to a strategic plan and initiatives and things like that. But we'll be doing that in May when we come with the 26-27 budget. And this is going to only cover the time period through the end of June of this year. So this shows a measure of our investment related costs. So we have a service that we've been subscribing to for many years called CEM Benchmarking. And they have a size-based peer group. It's like 13 plans, I think, all public pension funds. And what they do is they collect from each of them very detailed cost information related to the fees that are paid to managers that are based on assets or based on the carried interest for the liquid mandates only for the purposes of this exhibit. And then all of the internal costs that are associated with staff and research and external legal counsel, all of that rolls into this. So you can see there's been quite a diminution over time of our expense ratio, if you will, compared to the peers. So a key message for what we're seeking in the budget is the next 18 months at least, and perhaps a bit longer, it's going to be about normalizing resources to get closer to what we think is, a better model, a better resourcing approach. And really, we don't expect to look like every other pension fund in terms of how we do things. And we do have a bit of a benefit in the sense that we're able to start with a cleaner sheet of paper relative to many of them. So
Kevin, if I can just make one comment on here, and tell me if you disagree. My guess is that our expenses are even lower than this page shows because we don't have the amount of illiquid private equity that peers do, and you're not capturing those royalties.
totally, yeah. And I'm actually much more comfortable showing it all in with carried interest because I think that is a consideration in every limited partnership agreement. Carried interest is sharing profits. That's not the convention, unfortunately, on the public side, but you're exactly correct. If we had it fully loaded with all the carried interest, we'd be even lower. So don't want to give any impression that we think that by paying more or by having a bigger budget, we get better results. One does not follow the other. There's no causation there. But by the same token, if we're not adequately resourced, it's highly unlikely we're going to be able to provide the returns that our peers have over time. So this shows that same peer group translated into returns, and it shows the 5-year net total returns where the NCRS is really, really low on an absolute basis, and it's also true on a relative to benchmark basis. So again, the task we're signing on for is to improve that materially and expeditiously is kind of the watchwords that we've been using internally. So to put it in raw numbers as opposed to basis points, this shows the progression from 2016 through 2024. So if you look at 2024, we allocate about $10 million of cost in our internal budget, which is personnel, and shared services, contractual, which would pick up like external legal fees, research services, consultants, things like that. You add another $2 million of cost allocation that goes towards the non-retirement systems. We're at about 12 million. So the budget that we're recommending for the fiscal year that ends June 30, 2026 is a total budget of about $26 million. And that's obviously up relative to what we had in last fiscal year, which ended last June. And it's driven, this is assumption driven, right? So it's driven largely by the increase in personnel services. So for the purposes of the budget, and we have more details in the appendices that we can bring up and walk through some of this, and Chris said it's all great detail at his fingertips. That increase in the personnel services, about 65% of it is due to an assumed increase in headcount. So we've been hiring throughout 2025. We started the year with, I think, about 24 people on the team, and that's expanded. Now we're closer to 40. And then we're assuming that we'll probably hire another 6 people sometime in the next 6 months or so. And so we have mostly larger headcount, and then also a compensation adjustment, which reflects to a large extent what you just took up with Mercer and endorsed. Thank you very much for that. And so that's driving the bulk of our budget. Contractual services is also going up, and that's largely, if I remember correctly, reflecting legal services and things like that. So if you bear with me, I will skip the resolution and come back to that. This is the detail in the appendices, so I won't go through it unless there's questions. But on personnel services, if there's an increase in salary and wages, there's like a cascading waterfall effect. It impacts us as an employee, NCIA, Social Security, retirement contributions, medical, so on. On the operations and administration, we're really just bumping travel up. We think that we'll need to do a fair bit more travel, not just this year, but on an ongoing basis. So that's moving up. And then in the contractual services, you can see that the real significant move is using external counsel, which is essential for the types of transactions that we're doing, which are customized accounts, funds of one, SMAs, plus we're doing more in the direct space, right? So we sometimes have other types of legal analysis that's necessary, tax and others that we need to run to ground. So I'll go back, happy to answer questions on any of that. This is the form of the budget resolution on slide 7. And so what we're looking to do is to get the recommended budget approved, but with some guidelines. So one guideline would be that we separate the budget into personnel services and everything else, that the CIO would have the authority to move between those non-personnel service categories up to 10% of the budget. And the primary reason looking for this is, again, if we're normalizing resourcing, we can't be that precise in terms of exactly where we're going to need to spend money. So it'd be good to have this flexibility. And then to pick up a comment from Sally earlier around the, how do we plan for a budget when we're not sure what the head count is going to be? What we would like to have is the authority to spend in personnel services up to the amount that we requested. And then the CIO will determine which positions we need when they get filled, which is also sometimes a reflection of market and availability of people. So that would be the concept, to have that as a guideline. If we need an amendment following the phase 2 of the compensation study, we'll come back and do that. And then the final piece of the resolution is that until we come back in May with a recommendation on a scheme of administrative fees for our clients, we'll just continue to do this pro rata pass-through approach, which has been in place for many years. And that'll be in place until we get to the next budget. So those are my comments and presentation. Happy to answer any questions.
I just have maybe 2 questions for you, Kevin. The personnel assumes that all 61 folks are hired, like starting Jan 1, or
No. It assumes, I think, 6. I think it's 6 positions.
not 61 hired, but yes.
Yeah. 61, we kind of put together as a workforce plan, very loose, to cover us for 18 months. But, a more typical mature organization would not only have a strategic plan to tie these things to, but we'd also have a much more precise way to kind of calendarize hirings and each position and timing and all that. And to a certain extent, we wanted to be conservative, so we just assumed 6 positions will come on board in the next 6 months or so.
And then the other question I had, did the Investment Modernization Act, was it a 3 basis point limit that was inserted?
Yes, exactly. And thank you. I did not mention that. So that's actually on the bottom part of the of this table, where we did the calculation based on the methodology defined in statute, which is this rolling 3-year of our AUM. And so we're talking about a 1/2 of a basis point increase in spending authority.
Yeah, we're still well below. It's all good. Just want to make sure I was remembering.
Yes.
So Kevin, I had a question on the travel part of the budget. Just based on some experience, I found we typically in my firm always set it too low, and we underestimated how we align sort of sourcing and manager underwriting and the standard of quality that we want to sort of align around relative to that number. So can you tell me just a little bit about, where that number came from, or how you feel about giving you new hires, a lot of money to deploy, just how you're thinking about it?
Yeah, so again, I don't want to exaggerate the amount of precision.
Even though it's 761,501. Sounds really precise.
Well, it is in that sense. We pretty much looked at how we used to travel back in 2016 and the years prior to that. And we use that as a model. But we haven't gone through to do a bottom-up set of requests and then balance. This would be the normal process for me. Balance it across the asset classes in terms of need, geographies, length of time, stuff like that. We think this is sufficient to get us through the remainder of this year. And we had a significantly higher number for the following fiscal year. So we would expect to come back with,
Thank
more
you.
detail and more substantiation too.
Makes sense.
Any other questions?
Nope, I have nothing else to add.
I'll editorialize for a second because Kevin said something that he was, I think, being very gentlemanly in saying, which I'd take maybe a further step on. And that is on slide 4, slide 5. These two things are directly related. And I think everyone in this room understands that. So I understand how it may be perceived to take slide 5 and go back up. It is taxpayer money ultimately that comes out of the pension trust to fund this. I get that. But it's definitely worth it. And I think that's what we all sit around this table believing, but I just want to say that very publicly because it's easy to throw rocks at spending money in the state context. But what's important is it's like, this is where real taxpayer dollars are found. And this is our principal challenge. So with that, I would look for a motion to approve the proposed budget for the North Carolina Investment Authority.
Kevin, before we do that, I just want to, on page 4, just to, if I'm not mistaken, this is sort of saying that the 5-year performance has been below the 10% of, basically 90% performed better than we did,
To be
right?
precise, we're dead last.
Okay. So you're dead last, and and how many
About 13 plans. They're all similar size, about 100 billion.
over the last 5 years?
Yeah.
Okay, so I think that's important for everybody.
Very.
To just put it in direct terms.
1% is $1.4 billion. We are 2.2% behind. We're talking about spending $26 billion. So I think that is a great investment for people. But I still need a motion to approve the proposed budget for North Carolina Investment Authority.
So moved.
Thank you.
Second.
Thank you.
And just to clarify, the proposed budget includes the budget resolution that Kevin had on the slide. Is that correct? So, I'm sorry, who's the motion?
It's Roberts. Should be.
Ms. Lynch?
Aye.
Mr. Ward?
Aye.
Treasurer Briner?
Okay, thank you. So we'll go to comments sections. The first will go to board comments. This is where certainly free to bring up anything that we haven't discussed yet. Editorialize, it is your prerogative. Or we can move on to public comment section. I'll open the floor for any public comment.
No, I would just say, look, you guys are doing a great job with the team, and I think we've got a good plan over the next 6 to 8 months for how to continue to push things forward, which is very important, and create a lot of long-term value here.
I'm certainly honored to be here at the inaugural meeting. And I think we've seen 3 or 4 things already here today that this is why you're doing this. You're moving in the right direction.
I just want to say that I think I'm also very honored to be here, so thank you very much. But when you look at the data here of the amount that we have been staffing that we've had for this plan over the last several years relative to the sophistication of the portfolio that we have and are going to need to continue to keep in place, the staffing level is low relative to peers and in order to do that. And so I personally am very happy to see us start to put some manpower behind what it's going to take to manage these assets with this level. And it's growing and y'all are doing a great job. But I also look forward to seeing us, budget that even more. And I'm glad that we're, going forward from the get-go to do this right.
Yeah, and obviously, the team is mostly here. Thank you guys for bearing with us. It has not always been easy. It wasn't necessarily a linear path, but we're getting to the right place for the people of North Carolina. A huge part of why we're doing that and what we plan to do. So thank you. Then we can move to the public comment section. We'll now provide time for public comments for anyone who has signed up. Do we have any public?
We have one. Sakia Royal.
Yes.
Royal, please.
Floor is yours.
Good afternoon.
I'm sorry, before you start, you'll have 3 minutes, and I'll let you know when your time is up.
I'm sorry?
You'll have 3 minutes, I'll let you know when your time is up.
Okay. I don't have much to say. Thank you. So, good afternoon. My name is Sakia Royal, and I am a state worker. I am a member and the past president of the North Carolina Public Service Workers Union, UE Local 150. And as a proud endorsing organization of the Break the Bonds North Carolina campaign, UE 150 represents thousands of workers across the state of North Carolina in our state DHHS mental hospitals, cities like Raleigh, Durham, Greensboro, Charlotte, and in our university system with grad workers, groundskeepers, housekeepers, etc. Our state and city governments only work because our members do. The vast majority of our members are North Carolina state pension holders, and we believe that people everywhere deserve to live with safety and dignity. We are outraged and embarrassed that the state treasurer would invest millions of dollars of our pension funds in Israel bonds. Our state employees and teachers deserve much better. These investments are not making money for our teachers and state employees. Most of the North Carolina Israel government bonds are only bringing 2.75% and possibly 3.25% in interest. And we can currently get that at a higher rate of return from some high yielding savings account. So these investments are risky because Israel's economy is unstable. American credit agencies have downgraded Israel's credit rating, and Israel's long-term economic outlook is unstable. With businesses closing and going bankrupt at alarming rates. Israel's reliance on foreign debt has increased dramatically in the last 10 years, representing 25% of the total public debt, excluding insurances and pensions. So, and if I'm not mistaken, we have the treasurer share with us that he does not find Israel debt compelling for the risk and return for perspective. So these bonds are used to support genocide of the Palestinian people, bombing hospitals, schools, and refugee camps, indiscriminately killing over 68,000 people. Not to mention, again, Israel's economy is so bad that the credit rating has been downgraded and Israel's long-term economic outlook is unstable. The funds currently in Israel bonds should be invested to help the workers in North Carolina by giving much needed raises and addressing staffing issues at our state mental health facilities.
Ms. Royal.
Let's see.
Ms. Royal.
Yes.
Time's up.
Okay, well, please divest. Thank you.
Thank you for your comments. Just as a couple editorial matters, we do post on our website our monthly holdings. And so I encourage you and your organization to check those to see what we do and do not know. And then we are, of course, bound by House Bill 750, which everything we do must be pecuniary factors only. And so we're, of course, going to follow that policy. So no other public comments?
Yes, sir.
All right, consider the public comment section closed. I think that brings our business to a conclusion today. So I need a motion to adjourn this meeting. A second.
So moved.
Thank you. Okay. Call the roll, please.
Mr. Johnson?
Aye.
Mr. Warden?
Aye.
Treasurer Brett?
We're adjourned. Thank you, everybody.